I really feel the markets are kind of getting divorced from the Fed.
The issue really is the lagged effects of policy.
I think that the Fed is going to have to continue to raise rates or stay higher for longer. The market is not pricing that in.
There are extremely few historical examples of the Fed hiking, pausing, and then resuming hiking.
I think the Fed has to sleep with one eye open well into the future because the economy has changed.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on Tuesday, 4-day work week on radio, on television. Ferro on assignment, one of 3 islands, somewhere warmer, better, prettier, cooler, fancy.
How do you get one of those assignments?
I don't know. I'm looking for that. I'm looking for that assignment. Anyways, John's on a wonderful assignment. We're with you today. A really interesting day, to say the least. We've got a lot to talk about. SmartCast. Ben Laidler will start us off here on the equity market. It's not an equity-centric show, but we're really going to look at the stock market. And Lisa, with the futures negative 19, a little bit of a pullback. The single best sentence I heard in global Wall Street literature this week was this weekend, rather. Everybody publishing was Stuart Kaiser. It's Citigroup. Yet here we are, and boy, is that the feeling of the bulls and the bears. It's like after the Fed. Yet here we are.
And even though it seems like perhaps the FOMO trade feels a bit frothy, there still isn't necessarily anything to pull it lower. That was what Stuart Kaiser's point was. He doesn't really see any obstacle for it to be going even higher. So I'm wondering, are we there yet at the point where bears have fully capitulated and we've gotten a more balanced? Okay, well, that's sort of the key question right now. Have we gotten a bit over the skis with the AI trade, or does it have legs that can keep going regardless of what the Fed does?
Or could it be something else? And that'll be our theme here through the morning. Again, Ben Laidler, who's a confirmed bull, will join us here in a moment. Across all of the data, it's sort of a churning market here. Of course, we saw the Secretary of State in China. That was a drama over our long weekend, and it seemed to be constructive to get to more talks.
It was constructive, although a lot of questions around the substance, especially as lawmakers head to Detroit to question Ford and GM around supply chains and resilience, this whole idea of not decoupling, but sort of making supply chains more resilient. How do you parse that out at a time of such incredible competition between the two nations?
Soccer talk with John Ferro, we can do that, where it's petrodollars buying into English football, among other things, and the FT had it, Bloomberg has it this morning as well, but the Financial Times, Arash Massoudi and Simeon Kerr reporting, this is really interesting to me, Abu Dhabi, they're the rich ones with oil, looking at Peter Orszag's Lazard, and of course they walked away from the deal, but nevertheless, you wonder if that's the future here of global Wall Street.
There was also a story about Canaccord. There's this pressure right now on investment banks, which is basically revenues are going really down. There aren't the same kind of deals that there were, say, pre-pandemic and as they were last year. So at this point, how do you move forward at a time of such competitive pressure, margin pressures, competition, and some of these smaller boutique investment firms looking for perhaps not only job cuts, which Lazard did announce back in April, 10%, but also some sort of perhaps cash infusion.
And what's interesting to me, folks, this is really important, is the calendar of discussion. Lisa, I think we're having an end of June here. October discussions is how I'd put it. And it's underscored by, at least the interest of Abu Dhabi, the ADQ Wealth Fund with Lazard as well. So that'll be some of the themes we'll look for into July. We're going to do a brief right now. It's going to be a brief, but it centers around 400 Fed speakers between now and Friday.
There are a lot of Fed speakers, and perhaps they take on new importance after Jay Powell said, listen to what they have to say, not what I have to say. 8:30 a.m., the data dump, U.S. building permits, U.S. housing starts for May, and the Philly Fed non-manufacturing activity, also the economic indicator of FedEx earnings after the bell, which always is going to be interesting. I'm watching housing building permits because it gives you a sense of how much of a recovery and how much demand really is picking up in this sector. To your point, Tom, Fed Speak today includes it a half an hour. St. Louis Fed President Jim Bullard, he's in Barcelona, also evidently on assignment. 11:45 a.m., Fed Vice Chair for Supervision Michael Barr and New York Fed President John Williams are speaking at the Governance and Culture Reform Conference of the Federal Reserve. Very curious to hear what they have to say about banks there.
And sometimes they speak there and they talk about banking, but they talk about things away from monetary policy. But I would really like to hear John Williams of the New York Fed reaffirm his belief in a low R-starred. Because the zeitgeist I'm getting, including from Jerome Powell, is maybe the lower R star is a higher R star. That would be the key thing today for me.
That the end rates that we will end up with end up being significantly higher than they have been in the past. It's a real key existential question underpinning the market. And today, on the China front, Tom, to your point, German Chancellor Olaf Scholz is hosting Chinese Premier Li Qiang in Berlin. That's at the same time that 4 U.S. lawmakers head to Detroit to talk with Ford and General Motors CEOs about perhaps moving supply chains away from China, particularly having to do with electric vehicles. Yeah. I just am curious how this tension evolves if you have the sort of diplomats coming out trying to make peace, but the political rhetoric is such that you are moving toward a more hawkish kind of feel, regardless of what the diplomats say.
All I can remember is John Lawler, the CFO of Ford, visited with us here a few days ago, folks, and he said, basically, we can't make enough Broncos. You know, it was just that simple. They can't make enough of the fancy car. Thanks, Liz Ann Saunders, for sending in a photo of her gorgeous antique Bronco. So she was born after the Bronco. She doesn't remember that stuff, but she has like out of Hollywood, you know, the big tires, and it's a manly car.
Are you jealous?
Liz, I'm very jealous, say the least. Futures negative 18, Dow futures at negative 130. The VIX 14.54 after the 13 print, showing the state of this bull market. I need to mention BitDog, 27,000 here. Let's make it 26,700. The yield space is really, really important. I'm going to go to 30-year bond. I'm not in the 4% watch, but 3.88% of the 30-year, up 3 basis points to 10-year, elevation in the 2-year as well. And that's about it as well. West Texas, $72, a little bit on oil, and currency market I can't make sense of. Maybe we'll get some help on that later. Euro dollar, 109.29 off of the Lagarde meeting last week. Let's get to it for a 4-day work week, and we start strong with Benjamin Laidler. He's global market strategist at eToro. And Ben, I look at what we've got here, and you say very simply, it is foundations firming within the bull market. What are the foundations of your belief stocks higher?
Yeah, I think this is very fundamentally driven. We've got a U.S. economy which is going to grow 2% this quarter. Recession risks have been pushed back. Earnings growth forecasts have doubled in the last 3 months. Absolutely the opposite of what I think the bears were looking for. We've had about 11 straight months of falling inflation. Break-evens, 5-year break-evens are at 2.3%, which is basically exactly where the Fed wants them. Consumer inflation expectations, we saw the latest numbers on Friday from the University of Michigan survey plunging. I think this is opening up. This is doing 2 big things. This is giving companies, relieving the pressure on their profit margins. PPI is running 4 points below CPI at this point. And it's giving consumers purchasing power back. Wage growth is now running above headline CPI. So I think this is this sort of Goldilocks scenario. And then on top of that, we now have this capitulation of investor sentiment, which I think has just given us this sort of latest leg up in markets.
Have the bears, I should say, fully capitulated? You talk about how this has been driven or turbocharged by that kind of short squeeze, perhaps. Is it over?
No, I think this is the sweet spot. I mean, our sort of long-term investor sentiment index is now neutral for the first time in a year and a half. So it's a long way off positive. And this sort of capitulation, you've really only seen it happen in the last sort of couple of weeks, whether that's the AA retail investor sentiment survey, whether that's the hedge fund positioning. It's been very, very recent. This is the sweet spot of people capitulating, beginning to chase this rally higher. There'll be a point in time where we get sort of worried that it's all sort of overbaked and overdone, but this is absolutely not it.
Ben, will this rally continue to be fundamentally driven if the Fed comes through with 2 more rate hikes, as they've promised to do later this year?
So the markets are fighting the Fed, as they've frankly been doing all year. It's just a symptom of the sort of data dependence outlook that the Fed has and that investors have. I think the incentives are different. I think the market is, more aware of the upside risks and is happy to maybe look through, maybe 1 or 2 more hikes. Whereas the Fed, I think, is going to be hanging on till absolutely the last moment. They don't want the market to loosen financial conditions off, prematurely. And I think that's where you're getting this sort of conflict. But to answer your question, I think markets are forward-looking. They know that we're much closer to the end of this cycle than sort of we are to the beginning. And they're looking for the next chapter here, which is that, we get this relief from interest rates, and we get a firming of growth expectations.
Ben, I want you to push against one of the bears out there, and you do this with such grace and character that I know you're not going to take a shot at Mike Wilson of Morgan Stanley. His core theme is we get a more rapid disinflation, and that brings nominal GDP down and revenue growth down. Not so much push against that, but simply what is your decades of experience about if you have a disinflationary tendency at the top line of income of the income statement, do you actually get a diminishment of revenue growth?
So I think that's going to happen. I probably just disagree with the magnitude, but I think there are two huge offsets here. So one I alluded to earlier, one is profit margins. Yes, you're going to get less revenue growth, but I think you're getting margin relief today. I mean, just the numbers out of Germany this morning, just to throw one number at you, producer prices in Germany in the last 8 months went from 46% to 1%. You're seeing a mini version of that in the US. That's massive relief to corporate profit margins, everywhere in the world. So that's one. That's a huge offset to less revenue growth. And two is I think this less growth will also bring lower inflation or bring lower bond yields. It'll bring lower interest rates. And I think that gives room, that gives some further headroom for valuations to rise. Maybe slightly less for sort of big tech, but certainly more for the cheaper bits of the market, whether that's sort of cyclicals in the US or places like Europe and Japan, which have frankly been the leaders this year.
I look, Ben, at the idea here of rotation. We are all, weaned on rotation in a book, and certainly, I guess there's beginning to be a broadening and rotation in the market, but with the post-pandemic and supply and demand dynamics of the bigger picture, do we not get traditional rotation in the Laidler bull market?
Listen, I think steady as it goes. I mean, I'm very happy to stay with those sort of defensive growth names, primarily big tech and things like healthcare, because we're not out of the woods yet. I think we've still got to get the Fed off pause and cutting interest rates. I think we're maybe 6 months away from that. That for me is the real trigger for the next bull market. Semantics aside about plus 20% and all that. So I think big tech and those defensive growth stocks still have further legs. I wouldn't get sucked too far into the rotation at this point, because I think most of the growth slowdown is still to come. I don't think it's a recession. I think it's going to be fairly mild, but it is ahead of us, not behind us.
Ben Laidler, thank you so much. It's hugely valuable with eToro this morning. They're on, I guess, a cautious tone to a second leg of a bull market. That's really the heart of it. Is what shifted here, Lisa, to me is it a bull market? Is it a bear market? Has shifted to, okay, it's a bull market, but now what? And where's that second leg? And that's what we're seeing from the equity bulls out there like Stolfus, Kaiser, and Laidler.
You mentioned Mike Wilson, and I love that he said, we've been so wrong when it comes to earnings, or not the earnings, but in terms of the market's response. And so they redid all of their numbers with different parameters and really scrutinized this and came to the conclusion they're still bearish and they still see declines.
Well, bring up the full screen here on Mike Wilson that we've got, Lisa. I think we've got a full screen here this morning on Mike Wilson.
Yeah. I'll read it for you. Given our fundamental view on growth, we find it hard to get on board with the current excitement. If second half growth reaccelerates as expected, then the bullish narrative being used to support equity prices will be proven correct. If not, many investors will be in for a rude awakening, given the very big reach for risk we are seeing. I can tell you, just from personal experience, there are a lot of people that are going to shrug that off and say, he just missed it. However, there is a question. We just had the longest weekly winning streak for the NASDAQ composite going back to March 2019. We are looking at questions around whether people have priced in endless returns for the AI promise.
Abramowicz with the save, Bramo with the I couldn't read the screen. The camera was so damn far away from the screen, I couldn't read it. Bramo with the save there on the important Mike Wilson quote. It's a good way to start it here. 4-day work week. That is just a joy to that, isn't there? 47 Fed speakers today. Stay with us. Sebastian Page at 7.
My hope and expectation is we will have better communications, better engagement going forward. That's certainly not going to solve every problem between us, far from it. But it is critical to doing what we both agree is necessary, and that is responsibly managing the relationship. It's in the interest of the United States to do that. It's in the interest of China to do that. It's in the interest of the world.
The Secretary of State of the United States jump-starting things in China. Lisa, I went to Shanghai once, and we decided to live large, and we stayed at the Peace Hotel, and I had the immense honor of staying in a room. They have 5 or 6 national rooms at the Peace Hotel, the India room, the China room, which you can't get in, the government owns that. And I was in some British fake Tudor Henry VIII room. And that is the room Kissinger was in the night before they snuck to Beijing in 1970, whatever, with Nixon. Was this the same? I don't think so. But it was pretty cool what Lincoln did.
Well, this is drenched in history for sure, although he wasn't really greeted by much of anyone. There wasn't much of a reception for him.
Did you see that? Yeah.
At the airport, except for a couple red carpets that looked like red lines, perhaps. It was sort of metaphor. And there's this question going forward of whether there was anything achievable coming out of these talks other than simply not escalating, which perhaps is a victory, at least for some in and of itself.
Meet and agree. The Secretary of State in Beijing getting off the airplane, sort of like the way Terry Haynes gets off the airplane at Reagan here, back when he's coming in from Dallas, DFW. He's founder of Pangea Policy and joins us this morning. Terry, just, you know, the basic idea, the shock of the Secretary of State of the United States at any country being shown or greeted to the country like he's coming out of Reagan. You know what it's like. You got to get from gate 10 over to gate 3 quickly, and your luggage is on the way. What was accomplished?
And those at Reagan know the infamous Gate 35X, and that was kind of what it was there, too. What was accomplished was the ability of both countries to say that they are continuing to communicate that is calculated by both sides as having the effect of diminishing tension somewhat. I argued before the meeting and would still argue that that's largely illusory. My takeaways really are simply that China sees the United States business community as as its friend geopolitically, and will continue to try to push that relationship. That China also is pushing the United States to what they call recalibrate its relationship in Asia. In other words, kind of back off and agree that Asia should be a Chinese lake entirely, which is an absurd proposition to the many countries who are our allies there. Thirdly, there's no military communications, and fourthly, there's no mention of Ukraine or Iran, for that matter. So we've got communication, but we don't have a lot of communication, and we certainly on either side don't have anything to show.
Terry, this is the political tension right now. Perhaps it was a win for President Biden in terms of not escalating any tensions further, creating some sort of open lines of communication. Was it a win when it comes to the politics domestically of a nation very much growing hawkish on China, and some calling for some sort of decoupling, which this president has pushed back against?
Well, I agree that normalization of communications is a win for President Biden regardless. I think that's very true. At the same time, we don't get much more than that. Not much has been gotten. Secondly, my contention would be that the United States policy towards China actually started to flip in, say, 2016, 2017, even before Trump became president. And it is among the most bipartisan and probably the most bipartisan policy area that we've got in Washington. So that's not going to change either. The vast majority of Washington wants communication with China. The vast majority of Washington also does not want a situation where we're either getting rid of our own geopolitical interests or putting our allies in more peril as a result of that.
One of the lines,
we're not doing that right now. So.
One of the lines from Tony Blinken's press conference after the meeting really stuck out, at least in a lot of the talk shows over the weekend and yesterday. He said, "We remain committed to our one China policy with the 3 communiques, the Taiwan Relation Acts, the 6 assurances. We do not support Taiwan's independence. We've made it clear that we oppose any unilateral changes to the status quo by either side." Is that controversial, Terry? And how is it being sort of spun the day after?
Well, it shouldn't be controversial because what Secretary Blinken is doing there is really underscoring that United States policy since 1979 in the Taiwan Relations Act remains the policy of the United States government. And there's been a lot of concern, a lot of understanding and misunderstanding around that over the past few years that frankly have been aided and abetted by both President Trump and President Biden in past statements. So, what what Blinken's trying to do is put a floor under that by saying, look, our policy is as it was, and it continues to be. Make no mistake about that. Clarity is good.
Jerry, I want to link this to our economics and our corporate relationships with China. Catherine Mann is at the Bank of England. She's one of the great American international economists. And Kathy Mann of MIT and Brandeis makes very clear that we have a codependency with China. We need them economically. They need us. She owns the high ground on the Trans-Pacific codependency. What is the relationship in these discussions in your Washington when they observe Tim Cook living that codependency at Apple and bipartisan presidents saying, no, we don't want to do that? How's that work?
Well, the vast majority of Washington understands the codependency, frankly, doesn't want to upset it. I find the whole war of rhetoric here, whether it's decoupling or de-risking or anything else, to be a little overblown on the street. Nobody's talking about removing Americans or American business from China. What China is trying to do simultaneously, though, is trying to attract and continue to have in American business and American investment, while at the same time making the terms under which non-China investment will exist to be more onerous than it already has been. But I don't see the United States as trying to take that away.
Terry Haynes, thank you so much. With Pangea Policy today on this historic trip of the Secretary. Lisa, I don't know where to go with this. I mean, I look at, the place I live, it's a 6-floor walk up, and down at the bottom are the boxes from everybody. And you look at the outside of the boxes. Which ones don't say made in China? I mean, very few, to be honest.
One of the offspring came home yesterday with a Nerf gun, and we quickly found out that it was also made in China. I will just say this. This is something that Tony Blinken highlighted pretty much in the forefront of his discussion, saying that de-risking is really the only logical way to go. Decoupling is not possible or even plausible, given the fact that trade in the past year has been higher than ever before between these two nations. It is not diminishing. It's quite the opposite, which is the reason why I'm curious about the business tensions. They need to stay in China. And a lot of the political tensions where it's kind of pushing back.
But you don't mention the military tensions as well. My high point of the Bloomberg Invest Conference, yes, it was speaking to Nassim Taleb, but my high point was Anne-Marie Horton's piercing conversation with a retired admiral, Mike Rogers, about the trans-Pacific realities, and I'm talking north-south from Japan down to Singapore, and our build-out of our new Pacific Rim capability.
And I wonder how much that's also underpinning some of the discussion here, because a lot of the allies of the U.S. have said, when you have this kind of tension, mistakes happen. When you don't have the military leaders talking with one another to try to offset some sort of accident, that's when there are mistakes that can happen that could potentially be catastrophic on a military front.
Help me with a data check here. I'm looking at dollar weaker, DXY holding above a 102. I'm going to call it a resilient dollar, but nevertheless off the recent peaks. Yen doesn't go through 142. That's a big deal to me. Japan is under-discussed and very important right now. And the euro, Lisa, 109.
I'm watching just the fact that yields are creeping to the highs that we've seen since,
creeping.
That's just this ongoing grind higher. And to me, that's the collision course of what we're seeing with respect to the dynamism in the tech trade.
After the Fed meeting, the 2-10 spread, a negative 94 basis points. Fed speakers today. Coming up, perfect timing. Claudia Sahm on the Sahm rule. Bloomberg Bloomberg surveillance on a Tuesday, 4-day work week here in much of America. We welcome all of you. John Ferro, Lisa Abramowicz, and Tom Keene. John Ferro on an important assignment right now. Lisa Abramowicz and I dealing with a data check that's sort of boring and sort of churning as well. And it's sort of there. And like Lisa said correctly, yields is probably the place to go. What's credit doing? Do you still have magical corporate and high yield spreads?
Well, there had been this sort of steady grind lower, and now people are sort of reassessing whether it's gone too far. But I'm looking right now at just high yield bond spreads, and they're at this narrowest going back again to right before some of the banking concerns started up again. I would say that there is something interesting in the data this morning, which is there is a more marked, more pronounced direction lower in stocks for the first time in quite a while. And this comes after a really long run, 8 straight weekly gains on the NASDAQ. Is this a pause? If it's a pause, is there a reassessing going on? Even to Ben Laidler's point, how much more does another leg of the bull market have? If it is just a singular development in a cohort of stocks and not necessarily more uniform.
To give you an idea, folks, and I'm not going to show this on TV because on radio people would drive off the road, but to Lisa's really, really important question on the Standard & Poor's 500 on a percentage change from where we are right now, the center tendency is about a 4% pullback, and we're nowhere near that right now. Just, there's some quick math you can do on this. And what this means is there's been a moonshot really since the last week of May, I'm going to say, a moonshot from 4,100 up to 4,400, one of our themes through the morning. This is a joy. It's a joy always to speak to Claudia Sahm. She's founder of Sahm Consulting, Bloomberg opinion columnist, and former Federal Reserve economist. But far more, when you're that young and you come out of Michigan and you're codified with a rule in your name, there's very few people in the economics game that can say that. Claudia, where did the Sahm rule come from? Was that a paper you did in your spare time on a trip to Europe and said, I think I'm going to come up with a rule? How did the Sahm rule get invented?
The reason the Sahm rule exists is it was part of a policy proposal I had to automatically send out stimulus checks during a recession and to calibrate, how much you send out, how often. So it really was a sidebar to the policy proposal. It's turned out to be considered relatively useful to people watching recessions, but that was never the point of it.
The Heritage of Michigan with Betsy Stevenson and others there with Claudia Sahm. The Sahm rule is now full front and center. Colby Smith writing it up in the FT 10 days ago. How many states are in recession based on the Claudia Sahm rule?
Right. Well, there's different ways you can calculate it at the state level, but somewhere around 10 or less states are in a place where their unemployment rate at the state level has risen more than a 0.5 percentage point. So that's kind of the rule at the national level. We're not calibrated at the state level. And yet I think it's a good exercise to look under the hood and see how various states are doing in terms of their unemployment. And a big one within that group that has, this higher increase in unemployment is California. And that's a big state.
If you do look at some of these pockets of pain and then you look at the overall aggregate, does it make the overall aggregate look worse or better? Because some of the increase that we've seen in unemployment have really been driven by a few pockets of pain.
Right. And that's the thing to look at in a state like California. There's been some very specific areas of distress. So you think about the tech sector, which is important to California's economy. And the question now is where we see these pockets of stress. Do they spread? Do they resolve themselves kind of locally? And right now that is we can't know that yet. But that's something to be watching. It's that spread that could eventually push the whole economy into a recession.
A lot of people have said that we can't necessarily get a recession and we can't necessarily get unemployment creeping that much higher if you have consumer spending where it is. You say it's not a mystery. So what is this non-mystery telling you in terms of how long it can continue?
Right. So it's really careful when we look at various numbers to understand who's actually measured and how they're put together. Something like GDP, something like personal consumption expenditures that we look at, that's reflecting mainly a lot of high-income individuals who are spending. Whereas when we look at something like the unemployment rate, everybody counts equally. So I think it's where GDP, there's like this tension between consumers keep spending and spending, but that's in a setting where these data tell us a lot more about someone like Elon Musk than they do a Walmart cashier, right? So we have to be a little careful how the data are constructed. And I think that's why the unemployment rate, which is a much more egalitarian measure of what's going on, that's a good way to look, and that looks strong too.
Claudia, I'm so glad you brought up California. I wasn't aware of this, folks. I mean, I know California's ginormous, and I thought, Lisa, it was maybe the 6th or 7th global economy if you take it by itself. I'm wrong. It's the 4th. It's the United States, folks, China, Japan, and then the 4th economy would be California taken by itself. I mean, I think the financial media and, frankly, much of economics, Claudia, gets this totally wrong. They're these dominant states that are all Florida, California, maybe New York, and I'll let you decide the others, Texas, clearly. But are those 3 states not in recession while others struggle? Is there something to size in America that gives us a better stability?
It's really a mixed bag at this point. Again, we're trying to figure out, is the weakness contained or has it started spreading? California is the biggest one that's up in its unemployment rates have risen notably.
I look, Claudia, at the Fed meeting. Let's turn to that if we could, and the shock and awe of it. We had 2 major economists say, okay, well then why didn't they just raise rates? Were you surprised that after the verbiage, they just didn't raise rates in an Arthur Burns kind of way?
I was, though I'll give them credit. This is the most hawkish pause I could have imagined, right? Going out and saying, we're going to have 2 more rate increases, that's likely. Now, likely just means that people are putting 50% or greater odds on needing to raise rates. So it's not necessarily a done deal. I'm sure there was a robust debate at this meeting about what the policy change should be. But wow, that summary of economic projections really, nailed it home. We're going to raise, and it should have been a really clear signal. Forget about the chance of cutting this year.
It wasn't, Claudia. And what you hear is, yes, perhaps people aren't necessarily pricing in rate cuts. But as we heard from Ben Laidler, people are fighting the Fed. They continue to disbelieve that they're going to raise rates once, even twice, especially not twice more this year, and that they're probably done for the cycle. Stuart Kaiser saying that this is one of the biggest risks to the melt-up that he sees continuing, all things being equal. What's your probability that you assign to the Fed being able to go once or twice more based on what you were just saying? Unemployment, probably the best gauge of how strong the economy is, and it still is pretty good.
Right, but that's all the more reason in the Fed's eyes to raise rates, right? And inflation has proved sticky, right? I mean, they signaled July could be its live meeting. We could raise again then. They have a month of data between now and the July meeting. Like, what are they really going to learn that they didn't know already? So I take them at their word for at least that first increase. But again, this has got to be hanging on a knife's edge, because otherwise, just raise rates. Like, what are they waiting for if they think that's necessary? I still think that they're going to keep on to holding the rates high. And inflation is just too high for them to be that comfortable to cut.
Which is one reason why people are really curious to hear what Jay Powell has to say. He's heading to Capitol Hill Wednesday, tomorrow, and Thursday, and he's going to be testifying first time since the banking crisis kind of arose. How much do you expect him to double down and to say, you know what, you guys are getting it wrong. We're going to raise rates further. You can't just rally into strength and expect us to do nothing.
Right. And I think, reading the monetary policy report that goes along with, when he testifies, it certainly has that flavor. There are boxes on how we think about the what's happened in the banking sector. They still are they're lying. This is very isolated. This doesn't have anything to do with interest rate policy. I think you can see in that report emphasizing these same points. So like you said, doubling down on what he's already said. And I don't think, he's not going to want to go far from that script. Because they really did want this to be hawkish.
Claudia, one final question. What's our history of guessing or gaming or judging the trend and the second derivative of disinflation? Do we get that right ever?
Rarely. If you go at the historical record, within, a reasonable amount of time, facing this disinflationary cycle, how to do enough, how not to do enough. Because again, this is not Volcker Fed that walked in and said, we want this and we want it now. So there isn't much to compare it to. Frankly, the Fed's forecast, especially in the out years, it's like, wow, that's pretty optimistic. And yet they could pull this off. I mean, there's still signs of it, but I think they're going to be very cautious in stepping back, even as inflation starts to fall.
I mean, it's really important here. And I guess it comes down to the disinflation trend. And in housing, we get housing data today. Pantheon folks, and this was a wonderful article over the weekend, they were just blistering that the housing confidence and housing certitude, Claudia Sam, is just wrong. Harsh language. They said housing in America, the hope of it is divorced from reality. Have we become too complacent about the ramifications in real estate of these high interest rates, waiting and hoping for that disinflation?
Right. Well, I mean, housing is one of the primary sectors that the Fed should be working through to get to the real economy. I mean, that's one of the most interest rate sensitive sectors. And it's been, I mean, we've seen initially a lot of optimism pulled out and now maybe more back into the market. And as with all of these pieces, the Fed cannot move the economy on a dime, right? There's a lot of going on in the pieces, but that's a primary transmission mechanism into the rest of the economy.
Claudia, thank you so much, and congratulations on the amount of work we see on the SOM rule out there in this third quarter now. Third quarter? Almost third quarter of 2023. Claudia Sam of SOM Research. I looked, Lisa, at the 30-year mortgage, and, you know, the bottom line is it's all this blather, and yes, it's about the stock market, and, you know, we're all broke and all that. But what it's really about here is rent, housing, what you're doing with your kids, et cetera. And the answer is, here's my scientific survey. The housing market is nuts.
Well, especially in
New
York. And this is a region by region type of market.
City by city, yeah.
A lot of people saying it's starting to rebound after getting hit just slightly. I keep going back to the fact that no one is actually paying a 7% mortgage rate, or very few people are. They're paying 5%, perhaps direct from developers. They're staying put. So there is an inventory. This is the tension underpinning a market that's been remarkably resilient and is now turning in the other direction if you take a look at home builder stocks. If you take a look at pricing. I got the
30-year mortgage from 7.20%, 30-year bank rate, just cracked 7%. I got 6.99% right now. Critically, the long-term moving average is demonstrably higher than it was in late March, early April, and the intermediate moving average is almost up to a peak level. So it's a sustained, I'm going to call it 7.1, 7.2% mortgage rate. And where I see it, and John's brought this up many, many times, is the complete polarity between the places I look and you look are different. There's nothing for sale where I look. There's
That's the issue.
Nothing. Like, it's shocking.
Well, every day John comes here and says, basically, if you got some mortgage rate at 3.25% interest rate, you won the lottery. Congratulations. Why would you move? And nobody is. And I think that that's really the crux of the situation.
But in England, they're now talking about a 6% 2-year mortgage rate. I mean, that's like, you know, we're at 5.3%, I'll say, in T-bills, 3-month T-bill. Yes, 5.2% to round it up.
Yeah, well, housing,
6% 2-year fixed mortgage kills people.
Housing is not the office space market, and that's something else that we're continuing to grapple with. There was a study done by Columbia and NYU professors that showed that the implied losses for U.S. office buildings were about $500 billion, that these office spaces are about 38% lower than they were in value before the pandemic. When do we actually see that be borne out?
Well, one of my changed behaviors, major shout out to Cranes, which in New York City does a great job in this, is I read every single article about every single piece of real estate and the redo, the refinancing, and the workout of it. And that 38% number rings true to me. And that'll be certainly part of our theme in the back end of this year. Futures -17, the VIX 14.49. Yields up a point, 3.77%. Good morning.
There's been a massive structural shift in terms of the capital flow that's coming into China, right? It used to be the case that people just wanted to invest in China, build manufacturing capacity in China, but that foreign direct investment from companies has slowed very, very dramatically, and that has not recovered after reopening.
Jens Nordvig, wonderful, very important book about 10 years ago on the future of the euro. He nailed that at the time. Jens Nordvig with Exante data there. Futures negative 17, Dow futures negative 122. The dollar stable is what I'm going to call it here with oil, 72.09. I'm struggling with the data check because it's sort of a churn data check. Housing data coming out today may jumpstart things, and Fed speak as well as we rationalize what we observed last week. I do want to mention Bitcoin, some real focus there. Katie Greifeld's been really helpful in giving us clarity on that. Stable, 26,700 on Bitcoin. This is a joy to bring in Win Thin. He's global head of currency at Brown Brothers Harriman. Dr. Thin is very good on the Pacific Rim from his Burma all the way up to Japan, but also with a more global basis as well. Winston, when you approach currencies, what's the first pair that gives you information right now?
First of all, Tom and Lisa, thanks for having me. You know, it's always a pleasure. We've gone back a long way, and it's really always a pleasure to see you each and every time. I think dollar euro is the main pair, but to me, dollar yen has recently become to me the real barometer. Why do I say that? Well, that's where you really see the monetary policy divergence. The Bank of Japan has remained way in the dove camp, much more than anyone expected, I think, when the year started. The Fed continues to tighten and remain hawkish, and so that pair is really reflecting the monetary policy divergence. It's, in a sense, I think the question is still out on whether, sort of the dollar, the ECB Fed differentials and all that, and the BOE Fed differentials, but I think it's so stark, the difference between the BOJ and the Fed, that it's really what I like to look at it every day.
Okay.
And I think it tells me the dollar's going to get stronger.
We're going to rip up the script here, folks. We're going to talk to Win Thin here about USD JPY and EUR JPY. Let's start with the basic thing everybody on radio and TV wants. Win Thin, why should we care about the yen? Why should we care about flawed theory out of the Bank of Japan? What's a so what for our viewers and listeners worldwide?
Yeah, I mean, Tom, the Bank of Japan, I think, holds special interest because, they have been holding rates artificially low in the negative territory for decades. And the fear in the markets is that once they change, pivot, and go back to positive rates and end yield curve control, it will have global implications. That is, it will send shockwaves across the world. I am not as sort of doomsday as that, but I do have to acknowledge that, yes, it's going to be an earth-shattering moment. The markets will survive. The markets will pick up in pieces and come back, but it will be a sea change in really one of the largest central banks in the world, and that's really been affecting capital flows globally. For instance, Japanese, one of the biggest savers in the world, they've been sending capital abroad for decades, chasing higher yield, and that's going to be a big reversal when rates start rising in Japan.
If and when they blink, they restructure, and the jump condition here, I'll leave it up to you, but let's model, Lisa, $140 yen, and we get a much stronger yen, and let's say we get down to 120, 115, dare I say, we get back to what we used to perceive as normal. We get a strong yen. What's the ramifications to China basically flat on its global GDP back?
Well, China, it's almost become its own animal there. I do think that the strong yen will impact all the regional exporters, right? The weak yen has really been squeezing the competitiveness of not only China, but also Korea and Taiwan. Those crosses are at multi-year, sometimes multi-decade lows in terms of the yen. And if and when that changes, we have not only the capital flow story, but we also have the trade flow story. That is, Japan exports are likely to become less competitive. China may become more of a factor, but the reason I couch that with some caution is that China has turned so much increasingly inward in President Xi's third term. It's really hard to figure out how China fits into the global story. I do think that we're overestimating its impact on sort of global growth and trade right now. It's really turning inward. It's trying to boost domestic consumption. And you can see that in the regional trade numbers. Exports across the region are still diving double digits. And so, again, I think we spoke this last time I was on, that I think the world has to really rejigger and really try and figure out how to move forward with a very different Chinese model.
Wayne, one thing that you said was you look at dollar yen in part to get a signal for the dollar, and the signal right now is that the dollar is going to get stronger. How much of a pain trade is that?
Well, yeah, I'd say dollar yen has been the biggest pain trade. I think at the beginning of the year, folks were calling for 120, 125 yen. I imagine some still are. But that was really predicated on the notion that the Bank of Japan was close to pivoting, removing accommodation. And Governor Ueda has turned to be as dovish, if not more dovish, than his predecessor, Kuroda. And I think that was the game changer for dollar yen. Yeah, sure, they can surprise us. They love to surprise the markets. And we could eventually get a surprise in liftoff yield curve control elimination sometime in the second half of this year. But it seems to be later rather than sooner. The data out of Japan are turning. We're seeing some weakness in the hard data there. And I think policymakers really there are really shy about pulling the trigger on a regime change in policy.
On a broader level, though, I'm wondering, when does this sort of signify a broader dollar rally that isn't exactly what people are positioned for at a time when they've gone into emerging markets, where they've gone into the euro on the promise of both more rate hikes from the ECB as well as a stronger economy on the heels of whatever stimulus China is continuing to double down on? Do you buy into that is going to be the theme of the second half of this year, the reversal of perhaps a bit of dollar weakness in the first half, going back to dollar strength?
Yeah, no, Lisa, that's a great point. I think that was the other sort of consensus trade. The dollar's going to weaken. Fed was going to stop hiking and cut rates actually this year. And that's also been a bit of a pain trade. It has ups and downs. Obviously, the banking sector crisis kind of derailed the Fed tightening expectations, and we had the debt ceiling. But I think when all the dust settles, I think the Fed is going to go higher for longer. The market still doesn't quite believe the Fed. They've got one hike priced in, but the Fed has signaled there'll be two. And I sense that there are a lot of analysts that don't think the Fed will hike again. That is, this isn't just a pause. This is the end. I wholeheartedly disagree. I think the U.S. economy, to your point, you guys were talking earlier about how the resilience of the housing market, I'll throw in the labor market, consumption, et cetera. The U.S. economy remains solid. I would say strong, dare I say. And I think the Fed has to go much higher and much longer than I think the market's expecting. So yes, tying it all together, that to me tells me there's a stronger dollar in the works, stronger than what I think the markets expected when we started the year. Negative for EM, global liquidity is tightening still. Not just the Fed. ECB hiked last week. This week we've got the BOE, Swiss National Bank, Norges Bank, all hiking rates. And that's all, to me, very negative for global liquidity, global growth. I think the dollar still stands sort of head and shoulders above everyone else.
This is the point when you go right where I want to go. And this is maybe outside your remit, but I'm going to go there. You say the dollar stands head and shoulders above all else. I got completely wrong. For example, the equity return in Korea. Asia flat on its back, COVID and all, and up goes the equity stock market. How can you have international stocks do well with a resilient, win-thin dollar? I don't get that. It doesn't compute.
Yeah, no, I'm with you, Tom. And again, it's not just a resilient dollar, but also global growth is slowing. There's no question about it. The OECD and IMF, World Bank are all warning of much slower than expected growth in H2. Maybe we get a recovery in 2024. There's the whole equity market, saw that, markets are forward looking.
Right.
Are they looking ahead to 2024? It's hard for me to say, but I share your puzzlement, Tom. It's hard for me to see how emerging markets and global equities have done so well.
We got to go, but I got to get this in because you brought it up. Do you buy the IMF gloom? Do you buy the IMF 3-year global slowdown?
I think, we can all sort of talk about how right and how wrong the IMF has been. But I think in this time, they're right to err on the side of caution. Again, the U.S. is doing its part to hold up global growth, but eventually it's going to go into recession. I fear that. When is anyone's guess? But that's just another piece of the sort of the slower growth puzzle. China's disappointing. Japan's turning. We've already got two straight quarters of contraction in Eurozone. UK is going to go into recession. It's hard not to be gloomy. Again, but this is a run-of-the-mill sort of business cycle recession. It's not a pandemic. It's not a great financial crisis. So, if you want to look beyond that, we'll get through this and we'll be okay.
Okay, very valuable. Win-Thin, thank you so much. Dr. Thin is with Brown Brothers Harriman with a great focus on foreign exchange as well. Well, that was like on the edge of Bramwell. That was, he's cautious.
A lot of people are cautious. It's just that AI and everything is AI. So then what do you do with that?
As Bramwell mentioned earlier, the market craters today. The SPX down 0.4%, 16 points. Dow down 120 points as well. Stay with us on Bloomberg Radio and television, Bloomberg Surveillance.
I really feel the markets are kind of getting divorced from the Fed.
The issue really is the lagged effects of policy.
I think that the Fed is going to have to continue to raise rates or stay higher for longer. The market is not pricing that in.
There are extremely few historical examples of the Fed hiking, pausing, and then resuming hiking.
I think the Fed has to sleep with one eye open well into the future because the economy has changed.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Bloomberg Surveillance, Jonathan Ferro, Lisa Abramowicz, and Tom Keene. Thank you for being with us amid a 4-day work week. John Ferro on assignment, having, we hope, a restful time. Is he in the northern or southern hemisphere?
I don't know. I have to check his assignment calendar.
Check with his entourage.
We'll see what happens.
He actually takes some people with him just to be sure that, he gets on and all that. What an interesting Tuesday, and the conversations so far have been interesting. If you missed our last hour, Win Thin, I thought, was riveting on Japan and particularly on dollar resiliency. He just doesn't buy the gift of a weak dollar.
Yeah.
That's all there is to it.
And this would be one of the various pain trades that could potentially emerge in the second half that people are talking about, especially with the euro, given that it has started to break out.
Well, Ben Laidler getting us going here with some resiliency on this bull market. And coming up, this is going to be must listen, must watch. Sebastian Page with the definitive book on, what do you do in allocation? What do you do with your money? How do you diversify? We're going to do that here in a moment for Global Wall Street. For the rest of you as well, really can't say enough about that. This morning, I look at the churn of the news off a clumsy 3-day weekend and into an even clumsier 4-day weekend, and basically, and I make jokes about this, folks, but unfortunately, when Lisa does her brief, the Fed speak it beginneth.
To me, the biggest theme. Well, it's important, especially ahead of the all-important meeting of Jay Powell on Capitol Hill tomorrow and Thursday. It feels like there's a collision course, and I keep going back to this. The reason why people are bullish right now is because they don't believe the Fed's going to raise rates twice more, if at all. And this, to me, is sort of one of the underpinnings at a time when people expect inflation to go lower and for there to be some sort of immaculate disinflation, although no one wants to say this. If the Fed goes twice more, can the AI rally continue? And a lot of people are saying, tougher to see that.
Every 6 weeks, June 14 out to July 26 sort of captures a 6-week cadence. And I'll go there, and I guess the July meeting's important. But the next meetings are July 26 to September 20, which seems like wider, seems like foreverer.
Can I tell you this story that caught my eye? So Dan and Yogurt, they came out and they were talking about how they're an AI company because they're using artificial intelligence, to study the gut bacteria in order to craft something that's a better yogurt. Here's my question, right? So is everything an AI company? Is everything, if you basically say, we're going to use computer programming, we're going to use neural nets to try to understand our inner guts, then you're an AI company. At what point have we gotten perhaps past the peak?
I think I got to admit, I'm very happy you brought this up. You know what camp I'm in. The whole thing is ridiculous. There will be winners. There will be people that will move forward. I guess NVIDIA is a winner. I don't own it. But the basic idea is, yes, in every vogue, there's some validity. But at the same time, clearly John Lawler from Ford Motor told us Ford's an AI company. Bloomberg's doing Bloomberg GPT or whatever. I get it, but yeah, I think we've reached the silly season.
Well, a yogurt, I don't think of as being particularly artificial intelligence. Just to give you a sense of what did get the most in terms of trades, investors poured more money into Tesla last week than any other stock, and the other most popular contracts are NVIDIA, AMD, Apple, Meta. And those are, of course, the top AI trades. Tom,
I don't think they're doing AI trades right now, but I'm looking at Spotify, which if you have Offspring, they have Spotify. There's no question about that. And finally, I think this has been hugely anticipated within the music business. Spotify competing with Apple Music, with Tidal, and the rest, says they're going to have a premium tier, and it's going to have some form of hi-fi audio. They've been way behind on this. And we forget, here's something that essentially society uses each and every day with a return back 5 years. Yeah, 5 years 2.4% per year. I mean, it just hasn't worked out. There's no other way to put it.
Yeah, you're going to expect more of this. Right now, perhaps that's not enough to really drive everything higher. You are seeing stocks a bit lower as we do head and potentially a breather, although pairing some of those losses because you can't keep a good market down.
Don't start with the Fed speaker. Brief us on something more constructive than the Fed speaker.
8:30 a.m. U.S. building permits, U.S. housing starts for May, and the Philly Fed non-manufacturing activity. Also, I do say that FedEx, after the bell in terms of earnings, may also be an economic bellwether.
Yes, I strongly agree with this. I was not aware of that. That's why Abramo kills it. With the brief. We have FedEx after the bell.
That's correct.
Folks, it's as big as Apple's earnings. That's all you got to know.
Definitely a broad bellwether, also a bellwether. Fed speakers today include St. Louis Fed President Jim Bullard, who has been speaking in Barcelona, and at 11:45 a.m., Fed Vice Chair for Supervision Michael Barr, and New York Fed President John Williams. And then, of course, later in the day, we do have German Chancellor Olaf Scholz hosting Chinese Premier Li Qiang in Berlin. At the same time that 4 lawmakers in the U.S. head to Detroit to talk to GM and Ford about perhaps shifting supply chains out of China. So definitely differing messages from the diplomats versus some of the rank and file in Congress.
Moments ago, HSBC, the Hong Kong and Shanghai Banking Corporation, cuts their China GDP now this year to 5.3% from a more optimistic 6.3%. Not a small moment there, as we heard from Dr. Thin at Brown Brothers Harriman moments ago. Sometimes I miss it. And very often there can be a book of the summer or the book of the year, and it just, for whatever reason, in the Tom Keene blur, I blow it. I blew it with Sebastian Page's phenomenal Beyond Diversification. I'm going to give him the highest regard on this. This is the most important adult Wall Street book since Richard Bernstein's classic volume on value and growth. I can't say enough about it. Every time I look at it, I'm blown away by the acuity. Joining us this morning, the author of Beyond Diversification, Sebastian Page. The shingle is out at T. Rowe Price. Sebastian, I'm going to get right to it. You talk about quack remedies. What's the quackness of asset allocation in 2023?
Tom, we're going through a regime shift in asset allocation. You know, this is a critical time in capital markets history, in my mind. After 40 years of declining rates, we've finally made a higher high in rates, and we've wiped out $17 trillion in negative yielding debt. This begs the question, what do we do with asset allocation? Both tactically, how we navigate this regime shift, and that's been very confusing, but also structurally, the 60-40, you often ask that question on your show. I think the 60-40 needs to be modernized. I think of the 40, we should add maybe 15 to 20% in different alternatives and look for equity protection strategies. And so rethink diversification. This is a critical time for doing this, Tom.
This is really important. And folks, this is with the Sharpe ratio, with the risk-free rate finally back to normal. And the Sebastian Page religion is, you know what, folks, that was a nice 15-year gift. We're back to normal. We can't go out and find private equity. We're not Blackstone. We're not KKR, et cetera, Sebastian Page. How do our listeners and viewers participate in the Sebastian Page 50, 15, whatever the rest is, an alternative?
You know, liquid alternatives are interesting if you know how to select them. It really matters how you define liquid alternatives, but investment strategies that focus on relative value, that have less of the traditional market exposure, are also available in liquid forms. But it also calls for rethinking how you navigate markets tactically, how you protect for the downside. In a nutshell, Tom, the big question for the 60-40 is, what is the role of duration or treasuries when we get interest rate shocks? Now, to be clear, we just had a 500 basis points shock from the Fed. We're not getting another one. In fact, we've been adding duration back into our portfolios. But it's a critical question. If you look out 5, 10 years, What is going to be the volatility of interest rates? What is going to be the volatility of inflation? And how do you position your portfolio for those types of regimes? And this calls for things like hedged equity strategies. It calls for things like real asset equity strategies, you know, stocks that we kind of didn't really like for the last 10 years pre-pandemic, right, when inflation was below 2%. But energy companies, real estate investment trusts, metals and mining, precious metals, and so on, strategies that have a levered response to inflation shocks. This is all part of the new regime for the next 5 to 10 years.
Well, how much is this regime changing in real time? There was a time, perhaps, I don't know, 5 months ago when people thought that tech stocks were the most interest rate sensitive, and yet we've seen yields rise and tech rally in tandem. Is that connection also broken? Is that diversification in these two areas perhaps different than it was just 5 months ago?
Yeah, look, in the short run, say, think 6 to 12 months, we're navigating treacherous waters. I think the narrative around growth stocks has been driven by different factors. Lisa, yes, this correlation seems to have broken a little bit, but there's also an underlying narrative of, yeah, okay, we're pretty close to peak rates. Those big tech companies have shown that they're focused on efficiency. And then, of course, you know, you see positive surprises on cloud revenues, positive surprises on digital advertising, and then you hit sort of another kind of regime shift in AI. And that's really been part of the story. And you've covered it at length in your show. But, you know, AI's been around for a long time. It just seems like the large language models and the ChatGPT are kind of yet another regime shift we're going through. And that's all part of the value versus growth equation. Lisa, we went back to neutral in our portfolios. We were long value all of last year, and we benefited from that. Now we're basically back to neutral between growth and value. We don't want to be underweight if the AI bubble, quote unquote, if you will, is kind of like 1998, right? So we'd rather be at neutral right now.
Sebastian Page, thank you so much for joining us today with T. Rowe Price there. I can't say enough, particularly for pros, about beyond diversification. Hugely thought-provoking as well. West Texas Intermediate 72.09 if you're looking at the energy sector that Mr. Page was just talking about as well. 10-year yield 3.77%. The 2-year yield 4.70%. Standard & Poor's 500 up a negative 0.32%.
If you're just joining the program, we're taking a look at S&P futures that are 0.3% lower. And I do wonder, Tom, if we're looking at something that is the beginning, or to Sebastian Page's point, there is this issue of, you know, even if there is a promise, is there going to be a pause here? And how do you play that at a new time of perhaps interest rate expectations?
My problem with 60-40 spin, and he mentions Markowitz in all there in the book, I'm hearing people, Abby Joseph Cohen was talking about this as well. There's this alternative investment space, which is fine. It's a pro space, but I'm not sure how that gets into someone's 401k. I mean, if you get 13 choices in your 401k, we all know what they are. There's like money market fund, I'm almost scared bonds, bond portfolio got slaughtered last year, blue chip equity, growthy equity, foreign equity, and a bunch of marketing concepts. Where's alternative fit into that?
I will say, when I tried to get barrels of oil in my living room, it was very challenging to get real assets, and then to have the infrastructure around it, the ventilation, you know, dealing with children coming in. I mean, there are a lot of potential challenges to real assets that, you know, perhaps are not as you know, recognized by people saying go into alternatives.
I mean, to me, and this is the shock, and we actually dealt with it last week a little bit with the shock of the Fed meeting, and it's it's the idea that the game we're comfortable with for 15 years, it's done.
Maybe.
It's
Some
done.
people argue against that, though. Some people say we're going back to it.
There is a group that looks for rapid disinflation. One of the great themes that's out there. Good morning to Ed Hyman, David Rosenberg, and others looking for yields to come down. We'll drive this conversation forward at 8 a.m. On the equity markets, Scott Cronert will join us, U.S. equity strategist at Citigroup. We're looking at the equity markets, Dow 34,000, SPX 4439.
I raised U.S. concerns. shared by a growing number of countries, about the PRC's provocative actions in the Taiwan Strait, as well as in the South and East China Seas. On Taiwan, I reiterated the long-standing U.S. One China policy. That policy has not changed. We do not support Taiwan independence. We remain opposed to any unilateral changes to the status quo by either side. We continue to expect the peaceful resolution of cross-strait differences.
The Secretary of State on Taiwan, a little bit of a ferment about those comments. There's always, when you talk about Taiwan and your Secretary of State, it's like right from the start a lose-lose conversation. You're going to get something wrong on that. But the Secretary of State, after an historic, do you agree with me on that, an historic trip to China?
Breaking the tensions after some serious ratcheting up where people said it was the worst period ever in the relations between these two countries.
Terry Haynes giving us good perspective in the recent hour here. We do this with renminbi, and it's not the first thing I look at when I come in, but let's get direct. Rounded up 7.18%. on a weaker Chinese yuan, and it has been a devaluation. This is really, really important, folks. Depreciation is where a currency is free and floating. Devaluation is where a government's really in charge of moving its currency around. And Lisa, critically, I don't know where China fits into that. It's so opaque. But I would use the word with China devaluation or sort of devaluation light, because they control the yuan to a huge extent.
Well, and perhaps they aren't necessarily getting involved as much as people really would like. That's one thing that kind of came up over the past couple of days is they're kind of trying to cut rates around the edges, but they're not delivering anything more major to really prompt some sort of more robust growth to come back in that economy.
We'll have to see on that. Right now, we get a brief on China. We do with Jeanette Lowe, Managing Director, Policy Research, Strategas. It is a Baird company. Jeanette, I love your note in that you don't mince any words. You say China is broken. That's such a outlandish phrase. What do you mean when you say, how do you mean China is broken?
Well, good morning. So we have been, obviously, investors have been thinking about whether or not there was going to be this big China rebound once it stopped its COVID-0 policy and started to reopen up. And we just really haven't seen that transpire. Instead, we do think that the Chinese economy is quite broken at this point, and they're struggling a little bit to try to figure out how to right the ship as they try to move forward. And we think that part plays a little bit into the talks with Blinken and the talks with U.S. business leaders as well.
So extrapolate that forward. I'm curious if you are seeing some sort of desperation on the part of China, or not that, but there's recognition of some of the declines. How can they give the assurances to businesses at a time when policy leaders are pushing them on the other side to de-risk, to move supply chains out, and frankly, that they aren't necessarily facing free trade in that nation?
Right. And so I think that China is actually trying to do that balance. So you have seen that there has been this issue with supply chains. You've seen increasing rhetoric come out of the United States where they're pushing companies to move out of China, to move to other locations, to reshore, to nearshore, to friendshore. And what we have actually seen is that companies have been moving out of China to some extent. We've seen production that is going to remain in China, obviously stay. But then if there is production that would actually move to other countries, they're starting to move those supply chains out. And we think China's actually been quite surprised by the rapidity at which that has happened. So they are now trying to do kind of a charm offensive. They're trying to make sure that they are still looking open for business. They're trying to meet with U.S. business leaders and try to convince them to stay in the country. But they also do recognize that there is this trend within the U.S., that the U.S. is also pushing this with the West to try to move supply chains out of China, de-risk or decouple, depending on what country you may be talking to. But there is definitely still a concerted effort, regardless of whatever conversations Blinken had with Xi over the weekend, that there is still going to be an effort in the United States to try to specific, areas of tech controls, things where we think that it's really important for the U.S. not to be supplying China anymore. That's going to continue to be a focus, and it's only going to continue to grow over the next couple of months. You've seen, as you looked at what's been happening in Washington, on both the Republican side and the Democratic side, there continues to be a push to try to be tougher on China. And so that policy is not going to change anytime soon.
Jeanette, one reason why it's really great for us to be able to speak with you is because you talk with companies and you talk with different policymakers, and you can find the cross sections between the two. You said the charm offensive is to convince U.S. companies not to move their supply chains out of the nation as quickly as you say that they are. Is it working? Are they buying into the charm offensive of Chinese officials?
So I bet that there, to some extent, there is an effort to, I wouldn't necessarily say buy into it, but I think that, companies are trying to balance as well. They understand, I think, what is coming from the U.S. side. I think they have to figure out how do they still manage their operations in China and try to also make sure that there are guarantees as well, that if there's something were to pass, if there were to be even another COVID, for instance, how do you deal with supply chains shutting down again? That has been one of the biggest concerns that's actually driven production out of China. But companies need to also kind of be on the lookout. And I think that they are by looking at supply chains, and they're seeing what is on the forefront of policymakers' minds in the US and even in European countries. And they also have to play that balance of how quickly do we potentially move? What do we move? And then what do we think is going to be the next steps over the next couple of years, and where do we see that impacting their bottom line?
If you're just joining us, futures at -15 here on a Tuesday morning, the VIX 14.43. Jeanette Lowe of Strategas with us this morning. Jeanette, I want to turn to the domestic story. And what I notice here with the distraction of Blinken to China is there's really not much going on in Washington. I know I've got to be wrong on that. What are you focused on within our domestic debate as we begin summer in Washington?
So the U.S. has been focused on the debt ceiling for the past couple of months. Obviously, that was resolved at the beginning of the month. And so now we're starting to see policymakers turn to other things. One of the biggest things that you're hearing talk about is what are they going to do about the budget? Are Republicans going to try to cut the budget more than it was agreed to during the debt ceiling deal? That's going to be a big fight. They actually have quite a bit on their plate going into the second half. And so we do actually think they're going to be rather busy over the next couple of months, but particularly towards the end of the year, as is normal in Washington. But they're going to be focused on China legislation in particular. They're going to be focused on appropriations. They're going to be focused on defense. And then we do also think that there is this possibility that we could see a small fiscal stimulus bill towards the end of the year. You have the House Ways and Means Committee actually did a bill last week where they tried to talk about, increasing the standard deduction for taxpayers and also cutting taxes for businesses, restoring full expensing for the R&D tax credit. We're going back up to 100% expensing for businesses. And so there's talk also of trying to do some of these things as well. And we think that that could show up again at the end of the year.
Is that to extend the Trump tax cuts?
So it is somewhat aligned to that. So he's kind of set up the deadlines where it would fall into place when the Trump tax cuts do expire in 2025. But there is this effort also, in Washington to think about looking ahead to the election year next year. So they also want to think about how is the economy doing? We think a small stimulus package is more likely if you actually have the U.S. economy slowing going in towards the end of the year. And so that's where this could also play in factor, is where they're trying to make sure that there's some stimulus to make sure the economy is in decent shape as we move into electoral politics.
Jeanette Lowe, thank you so much. Jeanette Lowe is with Strategas there on China and on our domestic policy. Did you see Greg Valliere this morning? He's been off. He's like Ferro. He took off like a 3-island tour somewhere. Valliere comes back, and his entire morning note with AGF, get it from AGF in Toronto, is on the deficit, on the interest buildup we have, higher interest rates, the amount of money we're paying for interest to the government. It's not, Valliere's never gloomy, but as Jeanette Lowe alludes to there, it's a really sporting 6 months forward in Washington.
Another way to put this is, remember when we thought that we would get some sort of fiscal discipline, and we talked about how the debt ceiling resolution seemed to try to enforce some sort of caps on spending. And here we hear Jeanette talking about an expansion in fiscal stimulus, right? So at what point is fiscal policy moving very much in the opposite direction of what people think it will be and continuing to support some of this ongoing prolific spending by American consumers?
I mean, the numbers are I've lost scope of the numbers. He's throwing around like 30 years out, it's a $50 trillion. I hug the numbers. I don't really know what to do with them.
I think it's a great observation. It's part of the reason why people don't really get a handle on what the deficit issues really are, because the numbers are just too big.
Of course, when you're in the triple leveraged all cash fund, you can't even hug the bull market as well. 44.38 on Standard & Poor's, negative 15. This is Bloomberg. Stay with us. Bloomberg Surveillance, good morning. Jonathan Ferro on assignment, Tom Keene and Lisa Abramowicz here trying to get a 4-day work week started. And it's just sort of a churn to the market. Lisa, do you have one statistic here that gets you excited?
Well, just simply where we've been, right? That we've had 8 straight weekly gains on the NASDAQ. That is the greatest rally, the longest rally going back to 2019. And we've erased all of the losses from 500 interest rate hikes that had been incurred on the equity markets. We have now erased that as we continue to chart forward. To me, those are some of the interesting aspects going forward as we perhaps take a bit of a breather this morning.
Let's frame that exactly. 4440 on SPX. I'm still not used to 4,400. There's some people above that, but not many. It's a pretty lonely crowd. Binky Chada may be leading the way. I believe he had 5,000 there at some point out 4, 5, 8 years. I'm kidding as well. Dow 34,500 on the Dow, negative 110 this morning. And NASDAQ of 15,000, not above 16,000. But, you know, as we sort of slide into Q3 and how many people have been wrong who have to readjust here, I really wonder the framework of a second leg, and I haven't used this phrase in ages, of FOMO, fear of missing out. Think of the size of the missing out of people that have been in the triple leveraged all cash fund.
I was trying to think this morning, is it FOMO versus the fear of hiking rates? Is it, what's the sort of bifurcation right now in markets, the fear of overheating that people are talking about? Taking a look at some of the specific names, frankly, is sometimes more interesting at a time like this where people kind of can't get their hands around what exactly is going on the macro front. Nike shares lower by almost 2%. This comes after Morgan Stanley raised concern about inventory problems, saying it could weigh on margins in the fourth quarter. And this comes after Nike has crushed it. The direct-to-consumer trend has absolutely given them this incredible boost, and yet difficult to understand the inventory picture and the shifting winds in the post-pandemic retail economy.
Before we get to stocks with Lisa, and there's some really interesting stories today, this is the where in God's name is John Ferro moment in the show. We'll be doing this every day as he is on assignment, and it's Pirelli. Like, I enjoyed so much watching the Montreal Grand Prix this week, and I really blame John for this. I've really gotten into watching it, and I won't bore you with the details of why it was so interesting, but Pirelli makes the tires, like all the tires of the Grand Prix. They have one company that makes them. The Pirelli CEO designate, Giorgio Bruno, is said to leave company. And basically, this is where the Italian government has stepped in and said to China, you can't own Pirelli. I'm saying this very loosely and very uninformed. I want to be careful of this. Tommaso Ebhart and Danielle Lepedo are a lot better at this than I am. But this is an interesting China story involving Europe, where Sinochem is involved. Sinochem International. I'm going to read this verbatim. The succession plan was part of a proposed shareholder pact between China's Sinochem, the company's largest shareholder, and Camfin Holding, but it's going to be radically modified by the Italian government. I find that fascinating. I don't know what to make of it, but there it is as a side story, if you will, on a Tuesday. What is the other stocks you see, Lisa?
I'm also looking away from the Italian domestic stories. I'm also looking at Philip Morris because this has been one area that has been really underplayed and people basically moving away from it due to some of the concerns about ESG. And some people now saying, including Citigroup, that perhaps it's undervalued, raising it to a buy from a neutral. Those shares up 1.4%. Alibaba, interesting because we're seeing it sag 2.3%. After they replaced their 8-year veteran chief executive, Daniel Zhang, then basically replaced him at the same time that people are concerned about a lack of stimulus announced by China that they were expecting. Chinese stocks and the ADRs are down just more broadly today.
I look at Philip Morris. PM is a symbol. It's very confusing. There's Philip Morris, there's Altria. And the 10-year total return, we're so used to in times past, where MO was an Apple-like blue chip certitude stock. No, 5.5% per year on Philip Morris for the last 10 years. So it's been different. This is not Altria. This is PM, the more international operation. Right now, speaking of international, Ian Steely joins us, CIO, Global Fixed Income, Currency, and Commodities, off the London desk at J.P. Morgan, and joins us in our New York studio. Thank you so much for being with us.
Thanks for having me.
I love, it's like it's a Haley Mills movie coming out. Remember The Parent Trap? There's the cash trap. You are blistering in your note about the cash trap. How grim, how wrong is it to be in cash right now?
I think you've got to think about what happens. So cash looks great today, but will cash look good in 6 months' time, in 9 months' time? If we are having the slowing environment that we're seeing economically, if the central banks do need to do it a bit of an about turn, then ultimately buying fixed income assets, buying core bonds at 4 or 5%, they give you that attractive yield, maybe not quite as much as cash, but then you get that capital gain over the course of the year if we do see a movement lower in yield. So there's a real benefit of having that. And then, of course, what we've seen really since Silicon Valley Bank is that right-way correlation has returned. And the good news is that bonds can become that diversifier in your portfolio. When we do have times of stress, we've seen over the last few months that bonds perform like they should perform. Unfortunately, like they didn't last year, but they are going to do it going forward.
Are clients growing disenchanted with cash, or is the cash trap incredibly attractive partly because it is a yielding asset?
I think actually clients at the moment, the clients that I speak to, like cash because they are a little bit confused about what's happening in the bond market. We've obviously seen these big gyrations throughout the course of this year, and then they're looking at risk asset valuations, and you were talking about it, the fear of missing out. Equity markets where they are today, credit spreads, particularly in, say, high yield credit where they are today, actually it's just safer to be in cash. But I still think that on a 12-month, on a 24-month forward-looking basis, bonds is probably going to deliver you a better return than cash.
Can you get bonds rallying and stocks rallying at the same time? And this has sort of been the real concern for a lot of people, that if you do get some sort of downturn, that's going to be a real problem for equities at a time when a lot of people are expecting that actually will act as a stimulant going forward for equity risk tolerance.
It feels difficult. I mean, that's sort of the perfect scenario. It definitely can happen, but there's a very fine line for it to occur because you would need to have that soft landing. You would need to have the central banks turn course at exactly the right time when they don't stifle growth too much and they just allow that sort of runway, that smooth runway to happen. That feels a bit of a challenge when you look at what the central banks have been highlighting over the last few weeks or so, is that they want to keep going. They want to effectively nail down this inflation problem. And the only way that I can really see the central banks being able to have that smooth runway would be inflation coming down off its own accord to the levels that they would like it to be. And that does feel like a challenge at the minute.
My read of the weekend, Gideon Rockman, the FT, short, sweet. And I knew the U.S. had bested Europe in nominal GDP over the last 10 years, but Gideon absolutely nailed how Europe is falling behind. A lot of people in America are curious about the ownership of European blue chips. You guys own this space. Should we be in European blue chips, or is there just truly an American exceptionalism?
So if you look at the composition of Europe, yes, it's definitely not as supported for the tech markets. Now, I'm going to say from a bondholder standpoint, obviously have maybe my equity cap on, but if you look at the returns that we've seen more recently, Europe is starting to take a leg higher. It's starting to improve. And I think the underperformance of Europe that we've seen for a long period of time is starting to come back. We're starting to get real rates in Europe, starting to get a lot more confidence around Europe. So I think actually there is some benefits to investing in Europe. But of course, I say I've got my bond hat on.
No, but you get your bond hat on. But this is really important, folks. One of the things is a different dividend strategy and dividend growth in Europe as well. Are those generally higher dividends in Europe a bond equivalent?
They are more of a bond proxy. We don't have that effectively tech element in the European markets. The yields that you're getting on the European space within stocks is attractive. Likewise, for the first time in a number of years, in a couple of decades, really, I can say the yields you're getting on European fixed income are attractive again. They are compelling. We're no longer at that zero or negative lower bound.
I have to say, at this midpoint in this year, I have to just reflect on the fact that people are gaming out 4% ECB rates at a time when people thought they could never get above zero, right? And we aren't necessarily seeing the fallout that people thought that there would be. Same thing in the U.S. As we take a look into the second half of this year, after a 500 basis point move by the Fed, can we say that the expectations were wrong, that some sort of increase, rapid increase in rate hikes would cause some sort of credit crisis, some sort of massive unwind of the years of zero or negative rates?
So I think it's difficult to say that hasn't happened yet. That still could well happen. But no, definitely, you're completely correct. We've seen definitely a more buoyant economic environment. We've seen consumers healthier than we had expected, able to deal with high rates. Now, you could argue that a lot of it is the pent-up demand that we've still got on the back of the pandemic. You could argue that we've had this huge amount of stimulus from the government sides that has supported it. We've had payment checks being sent to people. We've had furlough schemes in place over in Europe. I do think that over the coming quarters, we are going to start to see that pain coming through. If you look at some of the comments out of the Resolution Foundation in the UK, only around a third, I believe, or the Bank of England is saying only about a third of the hikes is fed into the broader economy. We've got a huge amount of mortgage refinancing to occur. I mean, these high rates are going to start to impact. They're just happening with lags, and possibly, maybe, I think the issue that people had was that those lags are taking longer to play out than people were expecting.
Maybe off your remit, but I'm going to go there because it's not a fixed rate, it's a floating rate. The floating rate structure of real estate in Europe, and particularly the United Kingdom, what's going to be the damage to the floating rate structure versus a much more fixed rate America?
So the good news for the UK is that the floating rate structure is not as bad as it used to be. We've had a number of people term out mortgages into 2 years, into 5 years. So it does push out, again, it pushes out that day of reckoning. So those lagged impacts take longer to come through. But we are starting to see the people that were taking in mortgages back in 2021, they're likely to come. I think it's about a third of mortgage refinancing in the UK happens over the next year or so. So we are likely to see it. Definitely, I can't argue with it. The US is in a better place with its 15-year and 30-year mortgages, where they were able to fix at 2.5–3% a couple of years ago and don't have to worry about it.
Lisa and I would like Ian to come back again when John's here, because then we'd be surrounded by British accents. I understand about every 4 words.
I understood everything. That was
I
fabulous.
understand Ian better than John.
Ian Steele,
thank you so much
for being with us.
Sometimes John, I have no idea
what are you talking about? John is completely
it's like
clear.
Ted Lasso. When John starts talking, when he really gets going, it's like Ted Lasso. There's like every 5th word I can't understand. Ian's like poetry,
Yeah, I'm going to send him a clip of this.
Send him a clip of that. Yeah. Ian Steele, thank you so much. With J.P. Morgan off the London desk in New York today. Futures are -14. Dow futures -116. Yields elevated. Stay with us. S&P, the percent, -0.3%.
Tom, one thing that I was reading about is the submersible, the submarine that is missing or at least off the grid, looking for the Titanic wreckage, and has a crew of 5. I'm just wondering what you make of this, considering the fact that it is not something that we want to relive with this, basically one of the worst crashes out there. People going down to see it and then potentially getting stuck.
Everyone of a certain ilk, of a certain generation, is always and forever scarred by the Thresher. It was a submarine of the United States Navy that just simply went down. And it was back with technology, it was a lot less than that. And it was just a frightening time for kids, very much in the zeitgeist for weeks and weeks and weeks. And America was humbled by that technological failure of the U.S. Navy and of our submarine fleet. And of course, it had so much to do with the modernization of our fleet. My only observation is all of us pray for these 5 people and a huge search, and a search at huge risk in a brutal North Atlantic. They've said it's brutal. Is that it appears that this submarine, to call it that, submersible, had very, very non-sophisticated technologies involved. And that will all come out, I'm sure, in the coming weeks.
Yeah, racing to find them in the 96 hours, I believe, that they have of oxygen, emergency
It's
oxygen.
brutal.
Yeah, we are all thinking of them, and definitely something that caught us all kind of in this horrible memory.
It is, and the Coast Guard out of Boston on that search will continue to follow that for Bloomberg, particularly out of London. and New York. Futures at -14, Dow futures -108. Stay with us. This is Bloomberg Surveillance.
It's moved from people taking deposits away because they're concerned about the health and safety of these banks, much more just people, okay, where can I earn 5%, 4%? What am I going to do with this money? So I think there's going to be this slow bleed. Banks are going to be forced to issue more debt. I think they're going to be forced to extend their balance sheet. So maybe they're preparing for that. So it's not overly concerning.
Peter Scheer, Academy Securities, head of macro strategy. So sorry I missed him on Thursday. He's always great, isn't he?
He's always
great. It's a great summary there of what's going on.
Talking about how we don't really care about the Fed anymore that much, or basically that's not sucking the oxygen out of the room. You'd appreciate that.
Well, yeah, and I think there's still ramifications coming on here. I made light of it earlier, but folks, seriously, I think the Fed speakers have some validity this time around after the absolute shock of that Fed meeting, which we're still within. I think we're still within the shock of the meeting of the 16th. What's today, the 20th? Are we already up to the 20th?
The pause was confusing, and there's a lot of explaining to do by not only Fed Chair Jay Powell, but also some of the officials. We'll be speaking later today, as well as into the rest of the week.
Dot up high, Mr. Bullard will speak as well. We'll see how he reaffirms the 2 rate increases that are expected as well. We're going to rip up the script here. We can do this with a guy extremely supple in the financial system of the world, and that is Bloomberg's Jan Patrick Barnett. He's in Frankfurt. And, of course, one thing to talk about is UBS and Credit Suisse and the mating and what it's going to cost. And the other is, as reported in the Financial Times this morning and with Bloomberg's reporting as well, that Abu Dhabi at least had meetings, cups of coffee, and no doubt good Zurich coffee, with Lazard. Jan Patrick, I want to rip up the script, and we can do this with you. And it's as simple as boutique firms, always with a European basis. They're out of Paris like Rothschild or Lazard, or they're out of Zurich. You know the names better than I do. But they are coveted by outsiders, including petrodollars. How pervasive is that tone in Jan Patrick Barnett's Europe?
Well, I mean, like the landscape here in banking and in general is different to the US, right? We have like the major European banks here who are all caught up in this de-risking that we have seen over the last 12 years, and then you have kind of a sideshow, so to speak, that has evolved in Europe over the couple of years with all those boutique firms that you mentioned, who are run by individuals, by people who are keen to take on more risk than the big banks can do, and that's something that we have seen in Europe for a while now, and I'm pretty sure it's going to continue because what we have seen now in the Eden of March, so to speak, with UBS and Credit Suisse and all the saga going down, and the ECB just yesterday saying they will put on harsher stress tests on the big banks. The risk appetite for those major banks in Europe, I don't see that going up. I see that rather staying the same or even going down. So there will probably be more for those boutique firms in the more risky parts of the business to grab market share there.
They're going to grab market share, but are they going to do it? And this is a delicate question, and I'm just simply looking for what Bloomberg reports with our great European banking team. But are they going to do it with majority foreign ownership, like maybe English football? Or is it going to be just understood to be minority ownership? How will that cut, including what we saw with Credit Suisse with different tranches of minority Arab ownership?
Well, that's a good question, and I mean, like going forward, the question to me is like, if you want to really like put a stake up there in a European bank, what are the lessons learned from the Credit Suisse story? And the lessons learned from my perspective is that you can't be sure anymore that you're being treated at the best outcome when the push comes to shove, right? So, is there anybody out there like super keen to build majority stakes in European financials? I'm not so sure. Of course, there are like lenders who are in a good position, who have a good business model, who have a, let's say, halfway decent balance sheet that can handle some storm at least. And can you build there an interesting stake for dividends and for share gains? For sure. But I think you can do that with minority stakes. You don't need to be a major shareholder here in any shape or form.
Yeah, and Patrick, you are at the epicenter of one of the biggest banking stories of the past decade, which is the Credit Suisse firm becoming part of UBS. And we're hearing some of the reasons why perhaps UBS wanted that backstop from European governments, from the Swiss government in particular. How much are the liabilities of Credit Suisse, making it difficult for there to be really the standalone entity that some people think, and that even UBS has said they want to keep?
Well, that's the very big question mark and the elephant in the room. And that's why the purchase price on paper was so cheap for UBS, where they just paid a couple of billions for an entity that was worth 15 billions not that far ago, because nobody really knows like what else is there underneath in the books, how those assets are going to perform in the next couple of weeks. Litigation is a big issue, and we see this today again. You can always like estimate this so far, what the regulator and other the courts, the judges will put on you. And let's not forget, UBS has a fair part of that on its own, on its balance sheet. So that's something that they figure out now, and that they have to figure out fast, because as I always said, like investors don't like uncertainty. And the benefit of the doubt for UBS, it's a complex merger, and we have to give them some time to figure out all the details and all the stuff. But I guess that the litigation is something that they're going to address rather fast. Because you don't want to have those headlines. They're never good, right, in any way. So you want to settle with the regulator here really fast and make sure that the amount is bearable, which I guess is in line with the story that we have seen today. And then you have at least one topic off the rails, and you can focus on the train going forward and what and focusing on the technical things of the merger and how to integrate clients and customers and all that stuff.
How is morale right now at the remaining Credit Suisse unit at a time when Sergio Armati talked about the need for a prudent corporate culture and emphasizing that and basically saying there are going to be pretty significant job cuts at the unit at Credit Suisse in an op-ed that he published over the past couple of days?
Yeah, I really want to know that, like in a broader scale. I speak to a couple of people, and what they are telling me is not like super enthusiastic. I mean, they know what's coming at them, and that is going to be a difficult few months going forward with the merger. And it's very interesting that we saw the chairman and the CEO both being very harsh in terms of what they're saying towards the employees. And that tells me again that their message right now is for the investors. They want to tell the investors that there will be no hiccups going forward. There will be no more of the same misjudgment of risk, misjudgment of balance sheet, that they want to reassure investors that this merger is going to be profitable for them at the end of the line. And for the moment, they don't really care about the morale. Of course, they need the people on board to going forward to make this merger work in the long term. But for the time being, I feel the main priority is like keep the investors on board,
right.
Make sure the share price recovers, and then we can talk about like the people who are left over and what to do with them.
Yeah, Patrick, one final question. It's a question that I would ask of Sonali Basak, our chief financial correspondent. It's June, and I understand you take 4 weeks off in August, as does everyone else in Europe. But what is the rationalization of headcount going to look like among European banks into the fall and even into early next year? Is there a foreboding to that?
Well, I mean, like the headcount of European banks has never gone up over the past decade. There are good reasons for that, and I don't see that changing. That said, most banks, especially the major ones, they have cut headcount so far that I'm not really see like if they can cut like more here. AI is the big thing in the room. I mean, like, let's see if the frenzy is entering the financial area as well, and if they can cut even more, if they use more technology. But the big thing is going to be Credit Suisse. I mean, the company had employed like 50,000 employees, 17,000 in the investment bank. And what he said, he wants to do massive cuts. And when a CEO says massive, it usually means like 50% or more, is my guess. So we will see 10,000s of jobs being lost here again, mainly from Credit Suisse. But it's also a topic still for the other European banks. Nobody's like really hiring on a big scale here.
Yeah, I'm Patrick Burnett. Thank you so much. Great brief there in European banking. Love that. From Frankfurt with all of his skill in journalism and banking as well. I'm absolutely fascinated how this works out. I mean, I mentioned this last week. I can't remember on radio or TV, but Lisa, I'm just so colored by my childhood and understanding of 3 Swiss banks, and I'm in shock that there's only one Swiss bank.
I think
whatever they say about whatever they're going to massage with Credit Suisse.
That is, I think, a shock that a lot of people are feeling, especially at a time where Sergio Armati in this op-ed said the combined Bank of Switzerland, because this is now the Bank of Switzerland at a time when competitors are being rolled up into one.
We'll have to see. Right now, and the data check, futures at -12, Dow futures -109, the VIX 14.36. Again, we're watching Bitcoin here just under 27,000, an eventful 10 days with Binance and Coinbase and Bitcoin. In the yield space, yields were higher, now they're lower, swinging around here. We've got some economic data coming out in 30 minutes. Remember, it's a Tuesday, not a Monday, so we do have economic data today. On the housing market, oil 71.68 on American oil, the dollar fractionally weaker. On radio, on television, this is Bloomberg. Good morning.
I'm very concerned that we are going to see a hard landing.
And nothing to suggest that the labor market is about to collapse.
There's no sense that there is a wage price spiral brewing right now.
If people start to think inflation is more sticky, then you are going to have more issues with wages.
I wouldn't be surprised that what we have is really a sluggish economy without necessarily having a deep recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Is FOMO running out of steam? And this is Bloomberg Surveillance on Bloomberg Television and Bloomberg Radio. Tom Keene, Jonathan Ferro, Lisa Abramowicz shot us off on vacation, which is a wonderful thing. And I ask this, Tom, is FOMO running out of steam at a time when we are seeing a slight decline in equities, but just a slight feeling, perhaps, in some of the analyst notes, that we can't avoid a reset after the run-up that we've seen?
Going day by day. As you mentioned, it's been 8 weeks of up and a little bit of a pause today, but and we're going to have another equity strategist on in a moment. Everybody's got a different view, but I would look at the marginal shift, and maybe it's a shift over time of where you go higher in your SPX estimate and the when of it. So you say, okay, we're going higher, but it's a year-end 2023 higher, or it's a mid-year or year-end 2024 higher. So there's a number of moving parts to what people are doing besides resilient bears out there that are just saying, no, this is all wrong.
You know, you raise a good point, and this is something we heard from Mike Wilson as well in the past couple of weeks, where he basically said, you know, we do see declines, but then they'll revive into next year, into the year after, when you start to see some of that dynamism. So then what's to say if forward-looking instruments are stocks? Why not look past the pain, get to whatever happens, then we never get to that sort of downturn?
Ian Steely, I thought, was very valuable in from London, joining us moments ago with JP Morgan. And, you know, he called it the cash trap. I make a joke about it, but I'm sorry. If you're in cash, you're not in the game if and when you move higher. And that's a 12/31/22 lesson. There's no question about that into this mid-year 2023, which is coming up in 10 days. But to me, the major thing here is, how do you recalibrate if you've been wicked right? How do you recalibrate if you've participated in the market? Yeah, sort of kind of like, how do you recalibrate if you've missed this? That to me is fascinating.
It's a tough year. My question is just going to be, is FedEx going to be an AI company when they report earnings after the bell? Are they going to say that they're using AI to dramatically transform their technology and suddenly their shares will pop 400%? I mean, at this point, are we looking at something where there is this reality underpinning some of the hopes and dreams, but perhaps people are getting a little bit frenzied and carried away and they'll sort of thirst for some sort of return?
Stay with our Bloomberg coverage on this 4 p.m. into 5 p.m. hour. Remain driving that conversation forward. And it's real simple. FedEx is a really important bellwether for what's going on and what we're going to see from corporations. And as you know, we've heard from others, and Stuart Kaiser mentioning it here, the revenue growth guess is the major thing. Bears like Mike Wilson just say the revenue growth's not going to be there, period.
Well, how do we get down to a lower inflationary environment if you don't see some pain? And that's sort of one of the key questions underpinning a market that has seen 8 straight gains on the NASDAQ, which is the longest streak of wins going back to a 10-week streak in 2019. Today, the losses are not that significant, clawing back just a touch. S&P futures lower by 0.3%, 44.41, not exactly a cry in terms of pain. I mean, we've retraced all of the losses since the pandemic. So not only since the pandemic, but since the Fed started raising rates by 500 basis points, Tom.
Yeah, I didn't get a broadening out. I mean, that was the phrase over the weekend. I think a lot of people published over the longer weekend here in New York City, and there's no question about it. broadening out is the phrase du jour, and we'll see if that continues.
I'm watching yields. I'm watching the creep higher. A little bit of a breather today on 2-year yields, going down to 4.7%, just a touch. Yeah, but they had been at the highest level since before we saw some of the banking concerns. And the euro gaining just a touch versus the dollar. We've seen that pretty consistently, especially given the ECB projections for more rate hikes.
2-10 spread, 95 basis points. It's just really quite wide and really speaks to the tension. As I said earlier, Fed speakers today may really have some value. James Bullard of St. Louis. Can we just assume he's the highest dot plot? I mean, is he the, I don't know what McKee would say to that. Is he the outlier dot?
Could be. I think that there are a number of people who are on the same page with him. And let's see.
In the equity space, we've really focused on this morning because we've listened to you on radio and television, and you want to know equity opinion around equities, bonds, currencies, commodities. Mr. Cronert is equity strategist and managing director at Citigroup. We're thrilled he could join us this morning. Scott Cronert, what a strange time. I want you to describe right now how you address in writing fear of missing out. Where is that in an equity strategy right now?
Well, where it is right now is in the performance gains you've seen in this tech growth component of large cap equities. And it's also increasingly showing up in a lot of our positioning data. So over the weekend, our quant colleagues pointed out that looking at futures positioning, it's about as bullish as you've seen since the global financial crisis. So there certainly has been a crowding in effect underway as this NASDAQ-led rally has really kicked in.
My head is spinning because I'll see on a given day, the bet is negative, the bet is caution, the bet is woe is me, we're all going to die, the bull market's going to end. And then you just said the bet is actually that people are very bullish. You can't have it both ways. Which is it?
Well, the starting point is the fear that was kicking in last year as the Fed peak hawkishness was kicking in, and we were really concerned about recession risk. And so you went into this year with probably a little bit more concerned positioning related to this mega cap growth cohort, which felt the impact of the multiple compression last year. Heck, we're using this 4,000 target that we can get to. The same target we used start of the year. Start of the year, we looked bullish versus the futures implied positioning. Mid-year, we're hanging on to this target. Now we're looking bearish. So, there has been a pretty good seesaw at work here. And I think the point we're making is that what comes with this price action is an implicit expectation around fundamental follow-through. And our concern, quite simply, is in the shorter term, for all of the AI euphoria kicking in, the higher you go now, the higher the implicit expectations you set up for, and that just sets a pretty high bar going into the Q2 reporting period.
So you think that this is going to be an earnings-led decline because we're going to see some sort of decline to get down to your target of 4,000 before going up to where you see it eventually ending up, which is around where we are right now. So is that really going to be the catalyst? Big tech earnings reports that disappoint?
I think we're going to find across the board. I mean, every company in the country better have an AI strategy that they're talking about as you go into Q2 reporting period. The issue is going to be to what degree does that show up in fundamentals? And it wasn't that long ago that we were thinking AI was sort of a 25 event. It's been pulled forward, courtesy of some of the big tech names of late. I just think that what we're going to run into is this disconnect with how hard the market is run versus where earnings expectations are. We started the year at 213 for 2023 earnings. We're up to 215 now. And so our call around earnings resilience has been very solid here. It's just a question of to what degree a lot of expectations are being priced in perhaps too quickly.
So you think that people who think the Fed is going to be the killer of this rally are overstating things, that there's going to be some sort of additional rate hike or two, and perhaps stickier inflation that could really undermine some of the valuations that have gotten baked in here. Do you dismiss that?
I think that's a part of the equation, right? So we're kind of coming at it more fundamentally based. But to your point, Lisa, I mean, you're still looking at a Fed that is going to need to see a little bit stronger deceleration in inflation metrics to feel comfortable changing tune. Again, here, Citi, the house view is another one or two hikes. And we're looking at a Fed funds futures curve that is quickly right-sized over the past couple of months and is now pretty comfortable. You're looking at a 5% Fed funds level into the end of the year. So every step we go in terms of nudging up targets for the S&P, you still have to compare that to the return on cash. It's a pretty interesting trade-off that investors are facing right now on this. But there's no doubt in our mind that a higher for longer Fed, higher than expected versus 2 months ago, the interest rate backdrop, all of this plays into an interest rate tailwind that does keep somewhat of a lid on where valuations can go.
Where's the lid on valuations 3 years out, 5 years out? I'm not talking about buy and hold, Scott Kreiner, but you've been doing this long enough to know the percentage of money that's in the game for the financial media is long term, like 36 months. How do you scope 36 months given all the angst that's out there?
So it's not easy to do, Tom, clearly. So the way we've kind of come at it, heck, a year or so ago, we were saying, hey, geopolitical risk premium is going to knock a couple multiple turns off the S&P. Now we're looking at this disconnect with how you're going to value growth versus cyclicals and defensives within the market. The way we're thinking about it is that what's happening under the surface, and this is going to be a direct AI and an indirect AI influence, the opportunity for productivity improvement across the S&P 500 and broader equity economic landscape here in the U.S., we think is going to get really interesting here. So longer term, we're pretty comfortable the market can hold a higher valuation, courtesy of mega cap growth and tech, but also because the rest of the market is going to prove out that it's less cyclical than historically perceived. And I think AI, in addition to other forms of technology that have aided and embedded productivity improvements, end up underscoring a higher valuation than many investors have gotten comfortable with. So from our view, this is all timing. We think we've run pretty hard. We need to digest the move. But the setup here as we navigate this recession risk in the second half of this year is higher for longer coming out the other side.
Scott Kreiner, thank you so much for the brief with Citigroup this morning. I think our team did a great job over the weekend, just lining up a set of equity people, all with different nuances.
Timing.
You know, I mean, we don't have an Arch Bear in this morning. Maybe we'll solve that in the coming days, but I'm fascinated by it. Dow futures negative 111, the VIX 14.36, off an S&P 4442. The S&P on a percentage basis, a negative 0.3%.
Yeah, if you're just joining now, we are seeing a bit of declines on a day where we're perhaps reconsidering the gains that we have seen over the past 8 weeks. Right now, I am curious about where the bears are. Is there anyone who's willing to come on and say that they're still seeing some sort of imminent crash the way that they were, say, 5 months ago?
No,
I have not heard
crash.
it.
I'm not hearing crash. I mean, that's Abramo talk. And the fact is we're not hearing crash talk. And maybe we should have a radar up because of that. But certainly there's a bear structure of a leveling, and I'm going to call it within a broad sense, 200 points from 4,400 down to 4,200, or dare I say 4,000. And then beneath that is really based off earnings. And what we heard from Scott Kreiner in the writing from Citigroup is their bet is away from that towards an earning resiliency.
Well, and this
that's
is,
the difference.
And people are expecting, even if there's a sort of soft patch, it's going to be a year-over-year comp issue, and that they're going to sort of see earnings gains in 2024. I keep going back to this. Then what is to hold people back from saying, okay, it's a long-term, forward-looking instrument. We're going to look past whatever softness is in the near term and look to what happens after that. I mean, how much are you hearing that kind of tone from a lot of investors
I
right
think
now?
it is people, look at the bear market shock last year, down 13%, down 17%. In some cases, a price down, yield up, and barely able to articulate that. In a bull market, we get the bounce off the bottom. Maybe it's a dead cat bounce. That's what the gloom crew would say. But then the answer is you form a belief that gives you the price always out ahead of the belief of a second leg up. And that's the bet right now. There's no question about that. Our bet is foreign exchange matters. Dollar slightly weaker. Euro over 109, 109.33. This is Bloomberg.
right now there's a herd mentality of ordering just to protect future slots.
We've always tried to be conservative in terms of net output, not to overproduce to the market. We know that is bad for pricing.
They already have substantial orders in the order book of both Airbus and Boeing. The problem is that even if you order today, you're not going to see those airplanes for the next 5 years.
Among others, the leadership of Qatar Airlines just saying, oops, I guess we better order airlines. It is that time of year. A guy just becomes more happy. He's usually very Bramo gloomy, and he lives to go to the Paris Air Show.
Oh, is that
have
so?
you ever been?
I have not been. Have you been?
I would love to go. I just like to hang. I just like to walk around Guy and his entourage and see Guy Johnson do Air Guy like he does.
I was reading one story talking about how there's a bubble in airplanes and just the incredible rush into just ordering as much as you possibly
can. Like a post-COVID thing.
Which to me, it's sort of, it really creates a really interesting environment given how massive they are, what the floor must be like.
We know to all of our audiences, airlines matter. That's why Bloomberg Surveillance has done so much on here over the years with a wonderful Bloomberg Airlines team, our aeronautical team, I should say, in transportation. No one's focused more on this than Guy Johnson. He's been committed to a study of the aviation business since time began. It is Boeing. It is Airbus. Who's winning the race now, Guy? What's a partial score of Boeing versus Airbus?
It's been a little quieter, if I'm being honest, for Boeing, but they had some huge orders coming into the show. You remember talking to Michael O'Leary just a few weeks back, Tom. He placed a massive Boeing order. So maybe actually, if you take it back over a few weeks, maybe it's more even Stevens. But we've seen a huge order from Indigo coming out of India for Airbus. We're going to be talking to Guillaume Faury very shortly about that order. But the real thing that everybody's talking about here, Tom, is just the fact that we've gone from nothing to everything. Lisa was talking about it. There's a possibility of a bubble forming, maybe. There's a sugar rush. Steve Harsey was in that clip just a moment ago talking about the fact that it's like kids in a candy shop. The question is, are airlines over-ordering in order to secure slots? Because both Boeing and Airbus and their suppliers, the engine manufacturers, are really supply constrained at the moment. So they're sold out until now beyond 2030, which raises some really interesting questions about how do you price aeroplanes in 2030?
One thing I learned years ago on this is, yes, the pricing is an art. I mean, it's just absolutely bizarre what a jet engine costs, et cetera, or a jet. Guy Johnson, how easy is it to cancel an order if you've made them? If I go out and buy 30 A320s, can I just cancel those the next year, the next 2 years?
Tom, I think you raise a really interesting question, and it's one that I'm going to put to Guillaume Faury. How tight is the wording on some of these contracts? What kind of inflation numbers are they plugging into these contracts? Where's inflation going to be in 10 years' time? These are really tricky questions that I think the airline industry is really grappling with right now. There is another way of looking at this as well. So if you look at the Indigo order, Indigo will take some of these aircraft. They're not going to hang on to them for that long. They'll sell them back into the market. So they place a huge big order, and then they kind of trade some of these aircraft as they need them, don't need them. So there are sort of shades of grey on this one. But yeah, how tightly the language on contract writing is being pursued at the moment, I think is a key question. And what inflation rate, what's the cost of money, all of these things really hard to manage right now.
A lot of people probably are listening to this and have one question in their mind, Guy. How big is the first class, is the business class versus everything else, which is evidently shrinking at a lot of airlines?
Business class is where it's at right now. It's interesting, actually. I've talked to a number of airlines, particularly out of the Gulf, over the last few days. First class is becoming less of a thing. So it's going to be a 3-configuration cabin that people are talking about now. So it'll be business class, which will be fairly epic. Then there'll be a premium economy product. Then there'll be an economy product. That seems to be the model that everybody's going with. But everybody apparently, Lisa, wants to fly at the front of the plane right now. It's the new thing.
Yeah,
you don't want to turn right. You definitely want to turn left when you get on that aircraft.
Well, I think that a lot of people want to. Whether they can afford to is another question, especially given how much prices have risen. You said fairly epic. What kind of epicness? Can you give us some anecdotes of what business class looks like now that first class isn't a thing?
Well, I think you talk to Qatar. They're certainly talking about upgrading their business class in a fairly significant way. You've got a new airline, Riyadh Air, that's just been launched here. We've just seen the livery for the first time. That's going to be a fairly big thing as well. And certainly the Gulf is leading when it comes to first class and business class. They may keep some of their first class cabins, and they are going to be cabins. But I think that you're going to see business class. Many airlines are now investing heavily in business class because they now see a different mix going forward. They see it being heavily skewed now increasingly towards the premium leisure market rather than the business class, which, Tom, I'm sure you will be quite happy to enjoy.
Well, yeah, it's interesting to see it unfold here in America. There's some outrageous stories in America about a shortage of gates at the airports and that. Guy, to your Airbus interview, which is very important. The A320 has 340,000 parts for a small airline. What's the technology right now of the big airlines? I see the Newark to Frankfurt Lufthansa Boeing 747, one of the last ones flying around, take off pretty much every day here in New York. And I'm just fascinated by where the technology of big airplanes is in 5 years. What's the new at Paris?
So you think about what's going to happen next, Tom. We are reaching the limits of current engine technology. And the old joke in the airline industry is you basically start with an engine and you bolt on an airframe. Yeah. And that is going to become more and more important going forwards. The next generation of engines are going to be a completely different architecture to what we have now. Currently, you have an engine that has a cowling around it. You have turbines within that. We could be going to an open rotor technology, so you don't have that cowling around the edge of the engine. It's going to be a kind of open aircraft. You get a big bypass going around the engine and becomes much more fuel efficient. But then you have to basically design the aircraft around that. It's going to be a completely different format. These engines are going to be bigger. They're not going to have cowlings. You're going to have to redesign the airframes. So basically, the question is, kind of, what are engines going to look like? And then you're going to have to think about what aircraft are going to look like beyond that. And after that, we're going to be thinking about hydrogen aircraft, and that's going to be a completely different ballgame. And engine technology, aircraft technology, and the way that engines and aircraft look is going to change dramatically again. So we're going to go through some really big changes. The kind of traditional tube wing engine model is going to disappear. We're going to change that over the next few years, Tom.
Guy Johnson, thank you so much. And we look forward to his important interview with a gentleman from Toulouse here coming up with Airbus at the Paris Air Show this morning. It's amazing how this is conversations at home. Everybody that comes over, everybody ends up talking about the outrage over what flying around like Guy Johnson costs.
Well, just in terms of both the front of the cab, he was saying everyone wants to be on it, and that's what airlines have been responding to in terms of how much they're jacking up the price. And that's funding the incredible gains that we've seen. Just did you know that United Airlines, that stock is up 42% year to date? The Delta shares are up 30% year to date. It's not that surprising considering they can continue to charge these things and you haven't seen price pushback, perhaps until now.
Yeah, it's interesting you say that because, yes, they're up and there's been a leg up here off the, the October bull market, or actually with United Airlines, I can go back to early summer last year. Off the pandemic low, 22 to 50, that's a big move. We all agree on that. But the bottom line is they haven't gotten back to some form of the trajectory pre-COVID. And we've asked Scott Kirby about this at Bastion over at Delta. How do they get, I don't understand how they get back to the profitability that we used to know. I mean, I'm looking at United Airlines. Guess what? They're making 6 cents on the dollar if they're lucky. It's like they're like a grocery store. Moving bananas.
And this is partly because they lost a lot of people during the pandemic. They are constrained on who they can hire, and they're having to pay up. I mean, they didn't pay for a long time, and that was a big cause for concern. And so now if they're using a lot of their disposable income to go toward pay raises and other types of maintenance, I mean, this is the reason why people are wondering, when does that change?
I have a family member who works for one of the major airlines answering the phone at home. She's like senior person. She flies to London for $10. How come we don't get that deal?
You can ask her that.
She goes standby, but we'll go to London this week. Let's go to London for dinner. Futures at -11. That's what Ferro's doing. He's on assignment. This is Bloomberg Surveillance. A holiday lengthened work week. That's what we've got here. Bloomberg surveillance. Good morning. Let me make my glasses on. I'm blind this morning for some reason. We welcome all of you on economics, finance, investment, and on international relations. Much of that going on with Secretary Blinken returning from China as well. Futures -12. Lisa, Dow futures -110. Bond market, we had an elevation in yields. We give it right back, waiting for economic data.
Basically, we're retracing a little bit of the gains that we saw at the end of last week. But just to sort of put this into perspective, we've seen an enormous rise, particularly at the front end. On the long end, we are seeing a little bit more tempered. But this has been a reset, a shift back to perhaps higher rates by the Fed than previously expected.
Including a 7% bank rate, 30-year mortgage rate as well. And that leads to housing data. And Mr. McKee, you've got the first blush of today's and tomorrow's housing data.
It's a little disappointing that neither one of you has hats on, because I tell you to hold on to your hats. Housing starts up 21.7% last month. Building permits up 5.2%. In April, housing starts were down 2.9%. That's a revision lower. And permits down 1.4%, which is basically unchanged. But this is an enormous jump in houses under construction. Overall, 1,631,000 annual rate for housing starts, and building permits at a 1,491,000 rate. And this is just... we thought it would be strong, but there's got to be a reason why it is this strong.
There's got to be a reason. It's as simple as this. And I see it, Mike. I look at, say, Zillow, pick the geography, Mike. There's nothing for sale. How messed up is our housing economics right now?
Well, our housing economics is sort of topsy-turvy because it should be the area that gets hit hardest by the Fed's rate increases. But you're right. There's not much for sale because existing home prices are rising because there's not much for sale. And that keeps people in place. Nobody wants to pay the new higher interest rates. But analysts say what happened after the Great Recession was everybody started building apartments instead of homes because everybody didn't want to buy homes because of what they'd gone through. Now people want houses, and there aren't enough houses out there.
The data today, or the data mortgage applications tomorrow, whatever, Case-Shiller, whatever, can you impute or think about what rent dynamics look like given housing data? Or are they two separate worlds?
Well, they're sort of two separate worlds, except that we do know there's been a lot of apartment construction, and we do know that apartment rentors had lowered prices to attract people during the pandemic. Then they jacked those prices up a lot following the pandemic, and now things are starting to even out or go down. So we should see in the inflation data a lowering of rent prices coming up, but now it looks like we're going to start to see maybe a year from now, prices go back up again, given the time lags that are in there. But the important thing here, too, is that we are seeing enormous hiring in construction. If you look at the charts, and I'll show one to Lisa on the 9 o'clock show.
Save it for the 9 o'clock.
Yeah, save it for the 9 o'clock show because I don't want to upset the people who are listening on the radio here. But the construction numbers are just amazing. Not only residential construction big, but we're starting to see heavy and civil construction because the IRA is starting to get some of the infrastructure projects going. And with that kind of strength in hiring, there's just one more thing Jay Powell has to keep an eye on.
14 seconds. Which Fed speaker today are you going to lean forward and listen to?
Actually, neither, because neither is talking on a subject that has to do with the economy or monetary policy. But just wait till tomorrow.
Wait till tomorrow. Michael McKee, we will wait till tomorrow, heading all of our economic coverage. This is a joy. You want to say something?
Yeah, well, I just want to bring this in. There's just that the judge in the case of the former president judge has set a case for the trial, has set a date for the trial of August 14th. So it's going to be about 2 weeks starting August 14th, just for those people who are covering it. But Tom, really very much front and center right now, aside from the political drama, the housing market. My key question here is, how much have we seen the bottom, and is it really resurging in a massive way?
In around the first debates of the Republican Party, Mr. Trump has said he will not participate in those debates, but nevertheless, there it is. This is a joy and a real sign of the end of this terrible pandemic. Peter Hooper has been vice chair of research at Deutsche Bank Securities. All of us, John Ferro, Lisa Abramowicz, and I agree. He's had the coolest remote through the COVID. He's up, I don't know where he is. It's absolutely spectacular. But we said, we want to be like Peter Hooper and be ensconced in New Hampshire or wherever. And he is here in our studios today. He is Deutsche Bank Economics with David Folkerts-Landau. We're thrilled that Dr. Hooper could be with us today. I'm going to rip up the script. Lisa's on top of some of the more current things. What were your thoughts, with all of your experience at the International Monetary Fund, to see the stunning 3-year and even 5-year outlook of cautious economic growth from the institution? Is that cautious view something valid?
That cautious view is very valid. In fact, it may be slightly optimistic. We're facing still, globally, a serious inflation problem. Central banks started out well behind the curve. They're catching up, but they have a lot of work still to do. We got a little taste of that last week from Jay Powell. I think certainly the U.S., Europe, both very much, and UK especially, looking at inflation that is persistently sticky at the core level. Mm-hmm. We've seen some significant progress at headline, thanks to dropping energy prices. But research we've done in the past on disinflation says it's easy to get inflation down from elevated levels to halfway there. It's the final few miles that are tough.
Deutsche Bank has had a committed view to the Pacific Rim for years. I can remember the books would come in, the orange and blue books would come in on the Pacific Rim from Japan on down to the Deep South. Do we have a clear picture of Asian economics and a clearer picture of Chinese economics right now?
Well, China's a bit of a puzzle. We had a big bounce coming as they opened up out of COVID, a strong bounce in growth in the first quarter. Things weakening, softening significantly, and to the point where it looks like we're going to probably need they will need some policy stimulus to get things back to where they want to have them. Our team in China is optimistic. They think that households are going to be spending. They certainly. Whereas U.S. households have spent down their excess savings, Chinese households have not, and they're now putting that into the housing sector. And we do expect construction and home building to be an increasing boost to growth. But it's a mixed picture, and certainly.
You talk about a boost to growth. Well, it's certainly being a boost to growth in the United States. The fact that we just got the biggest jump in housing starts going back than more than a year, considering the fact that a lot of people are saying we've seen the bottom of the housing market. Do you agree? And how much of a boost could that give the U.S. economy at a time when people are still saying, wait for the recession?
Certainly home builders. We got a big surprise yesterday on their sentiment, and now the numbers today. This is a large surprise. I mean, certainly that kind of increase in construction. I'm not totally surprised. The housing sector is tight. Vacancy rates are very low. Vacancy rates are high. Very low at this point. And you're looking at a residential construction as a share of GDP that's come down sharply from the peaks that we saw just after the pandemic. We had a big boost in the housing. It's come down for the last year and a half. I would say that if it weren't for the Fed and its job ahead to give us a slowdown and take care of inflation, we would be seeing the bottom. I think we probably have another little leg down, but the correction has already largely taken place in housing.
What do you think that Fed Chair Jay Powell needs to do tomorrow, the day after, on Capitol Hill, to convince markets that he actually is committed to doing something after this pause that was highly confusing for a market that just doesn't believe they have the teeth to go ahead with 2 more rate hikes?
Yeah, I think I was listening to Rich Clare to describe this conundrum as both awkward and hawkish, and I think we came up with the word hawkward as Powell's performance on Wednesday. To pause at a time when you're significantly raising your forecast both of inflation and of the level of rates that we're going to have to get to deal with the problem, Powell has a tough job, and of course he has a split view on the Hill. He's going to have to sell, yes, we can get inflation down, but without a major recession coming. If he pulls this off, it'll be unprecedented for a Fed chair.
That's a really important statement. Explain I mean, all the surveys and the snark is he's a very unpopular Fed president. He's going to, quote unquote, pull this off. Describe what pull this off is.
Pull this off is quell inflation, bring inflation back down to something close to 2%.
Right.
Without pushing unemployment up into the 5% plus range.
Your thoughts?
It's never been done before. We've had 7 major periods of disinflation in the U.S. over the last 70 years, okay, going back to 1950. Every one of those, inflation's come down at least 2 percentage points, driven by Fed tightening. Every one of those has been accompanied by a recession. So this would be unprecedented. Now, Powell does have a couple things going in his favor. I mean, one is that probably the most important one is that the Fed, thanks to all the hard work Volcker and then Greenspan did getting inflation down, the Fed got a lot of credibility. And secondly, inflation expectations are pretty well anchored right now. Longer term, they're still not that much above the level where we were over the last decade. That makes it possible, but it's a mighty difficult task to pull this off. I mean,
Very quickly, Peter, on Clarida saying we're not going to get back to 2% or 1.8% run rate on this economy. That's going to be 2.x%. Can our institution make the shift to a higher implied inflation, whatever that number may be?
Not this Fed, not under Powell's leadership, not under the current membership. They are absolutely committed to the 2% objective. They realize that if you do this at a time when inflation's high, you're going to kill Fed credibility. That's the last thing they want to do. Powell is the second-term chair. He wants to leave with a legacy of being Paul Volcker II, not Arthur Burns II. He does not want to be the one who's remembered as having let things slip on inflation.
I'll have to leave it there. Peter Hooper, thank you so much for joining us with Deutsche Bank Securities. Just fascinating. I can't say enough about Matt Lozzetti's call on not only recession, but the whenness of it. He absolutely nailed that. Futures at -15, the Standard & Poor's 500 down 0.3%.
If you're just joining the program, the S&P a touch softer, down 0.3% as we chart a new week post-holiday. Coming up on the Open, I am going to be filling in for Jonathan Ferro, who is, as Tom would say, on assignment. I would say on vacation, well-deserved. Sonal Desai, Franklin Templeton, Matt Miskin of John Hancock, as well as Jimmy Chang of the Rockefeller Global Family Office. We're going to be talking about really how much of a pause we could potentially get. Is this a FOMO market, or is this a market that's still worried about recession? And those two incompatible truths are really clashing up against each other. You could feel it this morning.
I'm going to drag it forward to the FedEx earnings tonight. I am in the camp that logistically you have to listen to what FedEx says about the pulse of the nation.
I would agree.
It's not a small matter.
I would agree. And is that really an indication at a time when they had been forecasting lower, right? We saw this pretty consistently, that they were concerned about people ordering less stuff. Does it matter if it's the stuff versus the services, and we keep seeing that bifurcation?
Well, down 83 cents. Are we going to revisit a 69 handle on West Texas Intermediate? $70.95, $71, let's call it, on West Texas Intermediate. Brent crude rounded up to $76 as well. I would note renminbi as well, off the radar, but important for international Wall Street. Renminbi 7.18 yuan. That's a shock.
And just to revisit this, the judge in the Trump case talking about this August 14th trial date and 2 weeks thereafter to really hold that trial. As Michael McKee pointed out, it's pretty fast. It's a very fast trial for an unprecedented case.
Well, yeah, and again, I would assume that, we'll see how that comes out, but I would assume that it has to do with the delicate nature of the evidence as well. Let's get a move on and get that fixed, whichever way it may swing. Futures at -14, Dow futures -118, the VIX 14.35. Stay with us. This is Bloomberg Surveillance.
I think the 60-40 needs to be modernized. I think of the 40, we should add maybe 15 to 20% in different alternatives and look for equity protection strategies. And so rethink diversification. This is a critical time for doing this.
really a part of the academic debate at this moment. Sebastian Page, T. Rowe Price, head of global multi-asset there. And I really can't say enough about how people are thinking on global Wall Street about what the new 60-40 looks like. I can't say enough about his book, Beyond Diversification. I'll be talking about that out on Twitter here over the coming weeks as well. Futures negative 14, Dow futures negative 121. It's a holiday lengthened work week. That's what we like to call it here. Lisa Abramowicz getting ready for the next hour of the Open. John Ferro on an important assignment right now. Lots of headlines coming out, sort of disparate headlines. We've heard about the Trump trial. Lisa just mentioned that as well. This just out moments ago, the Secretary of State, Blinken, speaking in London, announcing more Ukraine assistance tomorrow. We'll keep you up to date on these many international relation headlines through the morning. The 10-year yield is 3.77%. If you're a retail investor and you're a yield hog, you're looking at a 20-year duration, 30-year muni bond, whatever it may be, to grab that yield. And you have been absolutely slammed over the last 24 months. The Bloomberg Total Return Index down anywhere from 13 to 15 to 17%. An end of the great bond party. Megan Swiber is extremely acute at this with Georgetown Finance and Mathematics, Director of U.S. Rate Strategy at Bank of America as well. I'm going to start with a basic retail question. It was up and away for 10 years, 15 years, whatever. We got absolutely slammed, price down, let's say 15% to be kind. We've come back a little bit. Now what?
Yeah, Tom, I think this is really the question on everyone's minds right now. You know, you have yields at relatively attractive levels, but is now the time to be buying? And what history tells us is that you really need to wait until that final Fed hike of the cycle to feel more comfortable and confident going long duration at this point. And what we see from investors, the survey that we conducted at B of A, one of them is this Global FX and Rate Sentiment Survey, which is a really cool survey of global benchmark investors, has a pretty long history, 2 decades or so. And that tells us that right now, investors have more confidence being long U.S. duration than they have really at any point in time during that survey.
Give us a maturity time on this. I mean, let's frame this out. The Fed is at the 2-year space. Yeah. The belly of the curve is 5 to 7 years. Long duration, does that click in at 10 years or is it a different maturity?
I mean, you can think of it across the curve. Really what you see, though, and what we've been guiding investors towards is when you're talking about long duration, you're talking further out the curve, 10-year, 30-year rates. And those are more limited in terms of how much they can increase on the back of the Fed continuing to hike versus the front end of the curve, which will be pulled higher with the Fed delivering more rate hikes likely.
The problem I have with this is everybody likes to talk spread market and all these other professional distractions. I get it. Everybody read Fabozzi. I'm dazzled. Forget about it. The fact is bonds went down 15%, just as a round number. 100 par became 85. That's all there is to it. We've come back a little bit to 87, 88, 90, whatever that number is. Are you as a bond investor investing for total return or somewhere out there you get back to what we remember, or is this the new level we're dealing with?
I mean, to me, Tom, the answer to that question comes down to the inflation outlook. And right now, if you look at market price and kind of following up on the prior segment here, the market has a lot of confidence that the Fed's going to be able to see inflation back down to 2% in a year. And if indeed that is the trajectory, then you are probably going to see down. Exactly. Yeah. You're going to be able to see the Fed cut alongside that. But
the other thing you say in your research note is issuance, and this is where all my radar's up. Lisa and I talk about this all the time. What are CFOs going to do in this milieu? I mean, to me, you know, there's going to be the big guys call up. They make 4 phone calls, including the Bank of America, and they sell a gazillion bonds. But as a total, what will CFOs do on issuance?
Yeah, I think that is another important question here. And on the back of this repositioning that we've seen from investors more broadly, what you have Treasury doing now that we're beyond the debt limit is increasing issuance. This first wave is going to be in bills, pretty easily absorbed, because if you look at the Fed's overnight reverse repo facility, you got a lot of cash sitting on the sidelines that can go out and buy that. But the question here, right, is this longer duration stuff, 10 years and out. Who are the marginal buyers of that going to be? And I think at the end of the day, that's another risk to this very consensus view in the market that we currently see, which is wanting to be long duration at these levels.
But the consensus view, folks, to frame this as simply as we can, you're going to look out to 10 years, which seems forever away, 2033, 2034. You're going to buy it, and you're going to clip the coupon. If the price goes down, you've still got the coupon to carry to help you. But the hope and prayer of the market now, the consensus is price up along with that to a really pretty significant total return, right?
That's exactly right. And again, if the Fed is able to see the inflation levels that the market expects at this point, it makes sense for the Fed to get towards a more neutral policy rate setting, call it 2.5%, 3%, which means that you're going to have downward pressure on those yields at the back end. But really the challenging thing and the risky thing for investors is stickier inflation. And currently the Fed really doesn't have a lot of confidence in their forecasts. We don't think that they're going to stop hiking until they see core CPI coming closer to 0.2%.
Right.
We're at 0.4.
So what's your 10-year call, year end or 1 year out, whichever way you frame that at Bank
Yeah,
of
so
America?
year end we have 350, so a bit lower than the levels that we're currently sitting at. And that is really due in part to the fact that we're going to be beyond the Fed's final rate hike of the cycle. And you're going to have more conviction on what the inflation outlook will be. But in general, we're not expecting this very massive fall in rates. It's looking near term like you're pretty much going to be sitting in this range between 325, 375.
I don't know if you get into portfolio construction. I got like 8 ways to go here, folks, with Megan Swiber. But the answer here is it's real simple. Do you single point? Do you barbell, or do you ladder out maturities if you're scared stiff of the stock market?
Yeah, and that's the important point here too. Rates, duration in portfolios is the world's risk-off asset. And if you have more of this pressure here on the equity market, you're more inclined to see rates be that buffer, be that hedge. A key point here, though, is whether or not we're going to see this recession that many economists were calling for at the start of the year.
That's worked out.
The data's been so resilient, right? The U.S. economy is just a lot more resilient than what the Fed, what economists more broadly were ultimately giving it credit for, which limits how much you can really see the equity market fall and rates fall alongside it.
I got to go out to the long-term space. It's great when you see Apple Computer put out a 30-year piece or whatever, and it's sold in 2 seconds. Is well. What is the plus minus of long duration? Full faith and credit right now.
Yeah, I think you have to be a little bit more humble about how far rates can fall. The Fed, when they were implementing the flexible average inflation targeting strategy, a big part of that, right, was being able to see nominal rates move higher, be able to build in some buffer when they're cutting. So I think that the probability that the Fed cuts down to the zero lower bound is more limited here. You probably have to think that in a Fed cutting cycle, when we're in more of this mild recession, is closer to 2.5% than it is falling all the way back down to zero.
I mean, I'm looking here, and it's amazing how this is the trap, folks. You got to be careful here. As many of you know, I bought the 100-year Austria. It's like now a 97. I'm down 70% in that piece right now. It's on the mat. I mean, even with some of the constructive things of Europe or whatever, the Austrian 97-year piece is still. It hasn't come up. That's the trap you're talking about on a less inflammatory basis.
Exactly. And I mean, I think near term, you have more potential for the front end to be more volatile, move higher with the Fed continuing to hike. You see the market only pricing about another 25 basis point hike over the next several months. If they deliver on 2 more, which is our base case call, you're going to see more upward pressure on the front end of the curve. So we think that investors who've really been positioned for the end of the hiking cycle, which is curve steepeners, long duration, you need to be careful here. And I think a good way to hedge this is to push back on what the market's pricing.
Stop. The way to hedge it is to buy NVIDIA, right?
Yeah, I can't comment on that.
She's got Megan Swiber. So thank you for compliance for Bank of America. I can state Megan Swiber did not comment on NVIDIA as a bond alternative with Bank of America. Coming up, an important interview. Our Guy Johnson in Paris with the Chief Executive Officer of Airbus.